You don't get them all right. I think that's probably the view over at LT's. Okay, here we go. The opening trade is almost upon us this Monday morning. Let's talk about the numbers that we are going to be seeing. We're anticipating a cautious but positive start here in Europe. So let's see if we've got some numbers coming through. Not sure this is the right data. But anyway, let me tell you that at the moment, I think you're probably looking at a positive start. I can see out of the corner of my eye. FTSE 100 is up by around 0.2%. You've got the Stock 600 opening up around 0.1%. As I say, a moderate Monday, I think, is probably what we're looking for. The Spanish market maybe delivering a little bit more. We'll wait and see what the other markets do. I'm not sure there's any kind of huge movers on the DAX or the CAC this morning. They're going to make those markets open a little bit more slowly. But there you go. The CAC Iran maybe opening up 0.4%. Maybe it's just dealing with the legacy of last night and the closing ceremony over at the Olympics, Alan.
Yes, the DAX actually still not open, so that's where we still have some sluggishness. But as you say, modest gains then coming through across these European equity markets, up by 0.2% on the Stock 600. Looking at the sector picture, all sectors in positive territory apart from healthcare. That's the real area of underperformance, and Novo Nordisk appears to be having a bad day. So that is going to provide some downside weight given the size and scale of that business. Travel and leisure, the best performing sector. We saw last week that it was the leisure side, not the travel side, that was doing well. Well, today both seem to be not too bad. We've got some upside moves on the likes of TUI in the travel space, Flutter and Entain in the entertainment leisure space, moving a little bit higher this morning. Energy names doing okay, up by 0.6% on energy stocks. Some broad-based move higher for that particular sector as oil prices tick a little higher then, Guy. $80 is where we trade on Brent right now, up by 0.5% this morning.
I wonder how the geopolitics story is going to feed into that this week. We'll keep an eye on what is happening there. Do we see an escalation in the Middle East? Could that cause problems within the oil trade? It's interesting that other commodities are really softening up quite aggressively at the moment. Oil seems to be kind of holding in there. It's going to be interesting to see exactly what happens on that front. In terms of the stock stories that we're watching out for, Diageo trading a little bit higher this morning, maybe a sense of safety this morning. UBS into the numbers. LVMH is gaining a little bit of traction. So some heavyweights in Europe are gaining a little bit of traction on the upside, but it does seem as if there is a little softness in the healthcare sector this morning. Is that a signal maybe that the market is feeling a little bit more positive? Is there some specific news? Have I missed the note?
There's a Novo Nordisk seems to be on the back foot, but I'm still struggling to find the reason for that. We haven't got an opening price on some of the companies that have reported or there's news about this morning, also worth mentioning. So BT and Hannover Re, both of those still closed, so we're still waiting for prices on those. But yes, in the meantime, Novo Nordisk is one of those stocks that moves a little lower today. Let us get into a conversation about where these markets are. Let's talk to Julian Howard, who joins us from GAM, Chief Multi-Asset Investment Strategist, in fact, at GAM. Really nice to speak to you. Thanks for coming in, Julian. So let's do big picture here, because we came off a week that was pretty dreadful to start with, and then we saw a rebound in sentiment and all sorts of assets. So what do you make of the US growth story and where it heads? Because that was one of a number of drivers for the market turmoil last week.
Yeah, so I think US growth is actually pretty solid. I do feel I'm in the camp that last week was a bit of a scare over nothing, actually. I mean, if you look at the Atlanta nowcast, it's sort of over 2.8% annualized growth. The Q2 number was 2.8% annualized growth. Unemployment is about 4%. And yes, it's ticked up a little bit, but actually that's because a lot of people have entered the labor market. And if you combine that with jobs growth, that's actually a good thing for the US. And also for consumers, wages are still in positive real terms. They're actually making sort of headway in terms of their lifestyle is still positive against inflation. So I think that the background remains actually pretty solid. I think there was just a little bit of scariness around a couple of data points, that jobless claims a couple of weeks ago, and also that the non-farm payrolls was a little bit soft. But that's not a trend. One data point is not a trend. Usually you have to wait for 3 data points, and yet everyone has got themselves into this absolute tizzy. And I can't.
And does that make us nervous for this week then? Because we have plenty of data out this week that could make everybody nervous and send us into another tizzy. So what's CPI, for example?
What's the common factor? I think it's the summer, isn't it? And I think a lot of the traders are off their desk, and there's nothing wrong with training up juniors, but the juniors are manning the desks. I can't help but think that there's a bit of excess volatility around that, because normally we don't get this sort of paranoia over single data points. So yes, this week could still be a little bit volatile if that CPI number comes in unfavorably, if it comes in a little bit stronger than expected, and those Fed rate cuts don't materialize as expected. That could be problematic. But the growth background is fine. So I think for most investors who are set up for kind of long term, and you should be in it for long term if you're in equities, then this is potentially an opportunity to rebalance or even buy in.
So am I back to doing what I did before this time last week? Is it as you were?
Well, I don't think it should be traded around, to be honest, because I think if you're into equities, you're going to get the Siegel constant over a multi-decade period. That's a 7% real return. That Siegel constant is net of war, famine, pandemic, earnings crashes, recessions. It's net of all those bad things.
You have to have a really tough stomach, though, to ride through the pandemic with that as your background assumption. It's okay.
But that's what suitability is for. I mean, you talked about UBS's wealth management clients, but the job of the private banker and the wealth manager is to set up the portfolio so that there are diversifiers and offsets in case equities do wobble. That's why you should have the short-dated bonds or the alternatives or the hedge funds to ride you through.
That's fine, but a diversified portfolio has underperformed. So does that diversify before?
Well, depending on what it holds. I mean, if you held short-dated bonds, 2-year bonds, or even cash, where you get in the US, you get 5.25% with no risk. I mean, that has been the diversifier of the century, actually. If you actually held that, every time equities go down, the rest of your portfolio just carries on growing at 5%.
But if you wanted to keep with the equity market, you've had to own big tech.
Yeah.
Do you still do that? Usually when the facts change, you want to rethink your approach.
Sure.
Did the facts change last week in any material shape or form?
I don't think so, but what is slightly different is that we are moving into this investment phase with AI. The top 5 superscalers, according to research done by JP Morgan, are investing $180 billion over the next 12 months into AI. That is going to require some patience, and I think it does sort out the different types of investors. For the Reddit bros, they may not be able to stomach it. But I think for the long-term investor, that
investment is going to produce some volatility. It's not so the AI trade is not a one-way trade anymore.
It will produce volatility because it's going to take some time. We've priced a lot of it in, and now we have to invest and see the return coming through. And I think for some, should I say cynical? Maybe not cynical. Maybe more pragmatic. But I think, well, actually, I've got 80% of the return coming from this whole theme. Maybe I'll take some profit now and rotate away. But I still think there's juice in the AI trade. It is a major, major revolution. And these companies are run by smart people. They are putting huge amounts of money in, and it's not going to be for nothing. But it will take some time.
Yes, you make the point in your notes. You say it just requires patience. So what is the opportunity around other US stocks at the time when you still have confidence in those AI Mag 7 big names? I was looking at some analysis by Bloomberg Intelligence that says that the non-Mag 7 US stock universe is set to deliver its first profit growth since Q4 of 2022. So actually, despite all of the volatility we spent all our time talking about last week, if you go back to the earnings story, they see some sort of catch-up trade happening there.
Yeah, and I think you framed it correctly. It shouldn't be binary. It shouldn't be tech or. I think it can be tech and. I think you can actually broaden out your portfolio. I think US mid-caps are pretty interesting, actually. They're tied to the economy. As long as you're still confident about the economy, they are tied to the economy, and that's why you're seeing some of these earnings coming through quite positively. And they're quite big names. It's not like you're investing in a very obscure part of the market. Companies like Mattel, for example, or Alcoa, these are still relatively household names. And it just means that you're tied to the economy rather than what for some people might think is a more abstract concept, this AI revolution, which, as I've said, will take some time.
I hear what you're saying about what's happening with the economy, and you're reasonably confident. But what I did learn last week was the market clearly is scared of a recession. And any kind of indications that we are going to see a recession is going to produce some quite big amplitude in terms of the market swings. Do you think the data is going to become more ambiguous in terms of kind of where we are are we getting to the end of the cycle? If we are getting to the end of the cycle, what does the landing look like? I think it's going to be, is it going to become harder to judge going forward from here?
I think a lot of it will be consumer psychology and trying to understand what is going on with the consumer, because that is what's going to drive the US economy. And of course, this week we've got earnings from, I think it's Walmart,
Home Depot,
Target, Home Depot, and investors will be poring over that in minute detail to see if there's a slowdown. But also, I think it's worth bearing in mind, consumers have been on a revenge spending kind of trip, for the last 3 years. And in fact, the car that brought me up, the driver actually said he works in the travel industry as a side hustle. And in fact, a lot of people have delayed traveling until this year, because I was saying, why are the airports full? How is it the airports are full? How have people got so much money? So because it's been delayed. So I think there is still spending going on in selected places, but also I think consumers are tightening their belts in others. And you can see this in autos as well. But it doesn't mean we're going to have a recession necessarily. It just means some tightening of the belt in certain areas. Food as well. Actually, there's going to be a little bit of a reversion back to eating at home, funnily enough, and a little bit less on eating out. But again, I don't think that's going to unwind the US economy or completely throw it off track. I think there's just going to be a little bit of a consolidation phase.
So 2024, and we're still dealing with the aftermath of the pandemic and all of the trends that put in place. The long reach of that.
Yeah.
Thinking about another much-loved trend of late, that was to buy Japanese stocks, and then last week we saw that tested a little bit. You have a fairly neutral view on Japan. Better governance is something that many people have talked about. Where does that stand now? Goldman Sachs putting out some data saying hedge funds sold stocks in Japan at the fastest pace in more than 5 years last week, and we certainly saw the negativity at the start of the week.
I may have become a bit more positive because the Bank of Japan, of course, last week basically said we won't raise rates while there's market volatility. That's a put. They've just reintroduced a put into the market. So actually, I think Japan is actually pretty well supported. And on the yen, of course, cheap yen, good for Japanese stock market because of those exporters. And actually, I think the death of the carry trade is being called a little bit prematurely, and I reckon that will reinforce itself and also support stocks. And the reason for that is actually there's very little inward investment. This is the story that people aren't covering. There's very little inward investment into Japan. The net inward investment rate is 5%. It's the same as Burundi. It's extremely low, and that's why there's very low demand for yen. That's what's underpinning the carry trade, rather than what's happening with the macro, what's happening with the interest rates, and what's happening with the inflation.
So even with all of that excitement about the Japanese story of late, still those low investment
I think
levels.
it will reassert itself. And also, improving corporate governance in Japan means that Japanese companies are actually investing abroad a lot more. So again, less demand for yen. So these are structural reasons that are actually underpinning the Japanese stock market.
You mentioned the 2-year earlier. Do I just keep owning the 2-year as my diversifier? Is that the right diversifier?
You could go even shorter. Why not own the 6-month T-bill? Because there's debate.
So just buy a money market fund as your diversifier at the moment. Does that work?
There's a reason there's trillions in the money market, because there's no risk associated with them, unless you believe there's going to be a US default and around the deficit. Okay, that's a separate conversation. But actually, if you look at the 3-6-month T-bill, that's really, really attractive, 5.25%. Okay, let's say they cut rates by 25 bips. That doesn't mean it's the beginning of a pathway all the way down to 2%. Even down to 3%, there's no risk associated with it. You'd be hard pushed to find a better risk.
Credit's a diversifier?
Sorry?
Is IG credit still a diversifier?
Yeah, credit is, I think investment grade credit is okay. High yield I'm a little bit more worried about. The spreads are very, very tight, 3.5% spread on US high yield. Anything goes wrong. Now, I've painted a kind of fairly solid picture of the consumer. What if that goes wrong? Default rates go up, economy slows. It's priced for perfection. And so high yield worries me more.
You say in your notes, Julian, that the Fed could cut soon, but this may not be a cycle. I'm interested in what that looks like then.
I think it's the prevarication that's going on across all the central banks. I think the Bank of England also said this isn't the beginning of a cycle. The ECB, Madame Lagarde.
What's a cycle? What do you think a cycle is?
A cycle is we cut rates and we're going to carry on doing it in a very predictable
2, 3,
manner.
4.
Yeah, for the next 6 or 7 meetings, like we had in the old days.
Yes.
But now, because of the scare around the whole transient embarrassment, transitory embarrassment that we had in 21-22, I think the central banks don't want to make themselves hostages to fortune. So that's why it's going to be very, very piecemeal. And also that's what gives me confidence around the very short-dated rates.
So forward guidance is gone and we're back to being data-dependent.
It's data, it's meeting by meeting. But of course that's not really compatible with the idea of long and variable lags. So there is a dissonance there. So that has yet to be resolved.
This time last week we were talking about 75 basis points of cuts potentially coming through. And an emergency cut. Gillian, great to see you. Thanks very much indeed. Gillian Howard, Chief Multi-Asset Investment Strategist, joining us from GAM. Let's take a look at some of the biggest names we watch in Europe to give us an idea of what the core of the European equity picture looks like. Broadly positive. But most equities are up this morning. Certainly the bulk of the stock 600 is up this morning. There are a few notable exceptions. Novo Nordisk is softening. In fact, the whole of the healthcare sector looks like it's soft this morning. I've yet to put my finger on why. If anybody knows, I'm all ears. Please let me know. Maybe Joe's got some idea as to what is going on here. He's going to start with BT Group. It's just opened. What are we looking at?
So we have got to start with BT, Guy. We are seeing a gain of around 7% in that stock, the biggest move in 3 months for the company. We've got news that India's Bharti Global buying that 25% stake from Altice, the French company, their UK business. Drahi looking to get out of that, and as such, that is a decent move for that stock and the best stock on the FTSE 100 this morning. I also wanted to bring up Thiessen Group. So we've got news that they are offloading part of their steel unit. This is the company that's had massive restructuring over in Germany, but not actually getting a boost. A lot of negativity around that one. But in terms of the deal stories, it is BT taking the shine this morning, up around 7% at the moment. Then in terms of European earnings, we're sort of down in the mid-caps a bit at the moment, given that the bigger earnings are going to come later in the week, the kind of the end of the main earnings season. But Hannover Re getting a 5% gain, better than expected net interest income for the reinsurance company over in Germany. That one looking pretty strong today. Then we've got Aritza. This is the baked goods company, owner of Cuisine de France, maker of croissants and all delicious breakfast food. That one is actually declining, warning of weakness in some of their markets. Some commentary around a weaker consumer out of that firm today. And then back in the steel business, we've got Salzgitter, also actually specifically talking about a weak German economy in the statement. Quite an interesting read. If you want to take a look at that one, that's a maker of steel piping, that kind of thing, an industrial company, but weakening this morning. We're also going to stick on the breakfast theme. We've done croissants. We've also got coffee. JDE Peet's announcing the CFO unexpectedly standing down. A bit of a surprise for the market, and analysts saying that is pretty negative, but actually only seeing around a 0.6% decline. The market is slightly higher more broadly, so a little bit of underperformance, but that was unexpected. They said he's got to deal with some other stuff at the moment, so he's had to stand down for those reasons. We'll take a look at Stellantis as well, announcing those job cuts, 2,500 over in Michigan, over in Detroit. It's the truck business, too much inventory on the books. Actually not really getting much positivity in terms of the move on that one. We're down 0.1% at the moment, but it is a job cut story for Stellantis at the moment. There we've got some details on the screen very handily. 2,500 positions being cut. The CEO continuing to cut jobs as sales do decline. And as we said earlier, they did actually announce in December some job cuts for a similar reason, but not really boosting the stock. Too much negativity in terms of the inventory for that company. Then we'll bring you the morning calls. JD Sports cut to sell at Deutsche Bank, which says that US sportswear is declining actually in terms of some of the demand, and the costs are too high according to Deutsche Bank. So that's one of the worst performers in the UK, down 2.5% for JD Sports. But going the other way, we've got BE Semi. This is the rival to ASML, the chip machinery company. This one gets a buy at Stifel. That stock has slumped recently given the sell-off we've seen in tech, but they now see value in BE Semi. So that one is rising over in Amsterdam. BE Semi upgraded at Stifel this morning.
Thanks very much, Joe. Joe Eaton from our equities team with some of the movers today. Still looking at Novo Nordisk, Guy, and the drop there. 1.7%. I mean, to be fair, the rest of the sector seems to have pulled back from some of the losses we saw right out of the gates this morning. But this stock is still weaker, and it's such a heavyweight in Europe. Yeah. It has such an impact. And all I can add is that the volatility last week was quite unusual. If you look at how much it was down and then up and then down and then up, it was quite unusual for the stock. There was a lot of news flow around it, the company itself, its products, and then there was also the competitive environment for Novo as well that was in focus last week.
I'm trying to see if there's anything on Lilly that maybe caused it Friday. It's not ex-dividend. Anyway, I have asked a bunch of people. We may come back with an answer shortly. We'll figure out exactly what is happening. But equities do feel largely becalmed this morning. Is this basically a sort of moderate, measured Monday that we're going to wait? This is the kind of the calm before the storm. I can't put my finger on what exactly that cause could be though yet, so it's going to be really interesting to see what what that CPI print looks like, as we were just hearing. Maybe you do see the Walmart numbers being poured over in a great deal of detail. The BT story, though, is certainly one that stands out this morning. Yeah, this was Drahi's not Drahi's. There's always been a lot of kind of buyer's remorse around that stake. So the fact that he's offloaded it, I haven't actually seen a price yet. Maybe I missed that from Joe. But it'll be interesting to see exactly how Bharti's going to take this one and how this produces a different outcome, maybe for BT. Anyway, we'll talk about that a little bit more. India's Bharti Global has agreed to buy just under a quarter of the UK's BT group. We're going to figure out exactly what is happening here and what it means for the group going forward. Those details are to follow. We figured this one out. We'll figure Novo out as well. Just give us a little while. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
What are we, 22 minutes into the equity session, and a much calmer feel this Monday morning versus the last Monday morning that we had. European equities are up 0.1%. London getting a little bit of a boost this morning. Bunch of factors behind that, one of which is that we've got BT shares up strongly. This afternoon, news has emerged within the last hour or so that Bharti, India's Bharti, has agreed to buy a stake for around 24% in the company. It's buying that stake from Altice, the French company. Let's get more details about what we know and don't know at this point. Bloomberg's conglomerates media and telecoms reporter PR Sanjay joins us out of Mumbai. Sanjay, what do we know about this transaction at this point?
So it's a very significant transaction for Bharti Global matters, because this investment is done by Bharti Global. Bharti Global is an investment arm for the Bharti Group, the conglomerate which covers telecom to digital to hospitality. That's number one. And the transaction is done by Bharti Tele Ventures Limited, which has no connection with the Bharti Airtel Limited, which is India's #1 wireless carrier, or any other subsidiaries. This is done at the investment arm level, and they have agreed to pick up the stake of 24.5% in BT Group PLC at this point of time, and they will be going for the first tranche would be around 9.99%, and remaining will be done after the regulatory permissions are in place. And they have bought out at least stake as of now, and this is as part of they will get more firepower for their international expansion. And you would know that Bharti was helping in resurrecting OneWeb, and they have a huge investment in Africa too in terms of wireless carrier. So this is seen as an international expansion, and they will be getting more firepower with this kind of one large chunk. If you recall, in 1997, BT has acquired a small stake in Bharti Airtel, which is #1 carrier in India. So this is kind of India-UK relationship getting more cemented, and Bharti Group will now go for a search for new areas, new pastures for investment. As long as Bharti Sunil Bharti Mittal is concerned.
And Sanjay, we've heard from the chairman of Bharti today, making it clear that there's no intention to bid for the rest of the business. So with that in mind, what makes it attractive, do you think? Is this, you've mentioned the international expansion story, is this a play on the UK, or is it a play on telecoms? What do we think?
So he had also mentioned one thing. Now he's buying only a 24.5% stake, and he's not said clearly that whether he will be buying remaining stake at this point of no. So we have spoken, we have managed to speak to sources, but they said at this point of they're only buying this one, and he's endorsing this deal as a deepening, or rather cementing or consolidating their investment efforts in the UK, because both the Indian Prime Minister and UK Prime Minister have laid out their investment plans for India and more further ties between these two countries, and they are endorsing, or they're rather flagging this one as a flagship investment from India to boost efforts from Indian Prime Minister Narendra Modi.
Okay, thanks very much, Sanjay. Good to speak to you. Bloomberg's conglomerates, media and telecoms reporter PR Sanjay joining us there from Mumbai. So that's the BT story then, Guy, up by 6.4% this morning. So that's one of the movers that we're certainly keeping front and centre today. I noticed we've got some movement in some of the insurance businesses as well. Hanover Re, we were hearing about that from Joe a little bit earlier on. Jefferies pointing out there could be an uplift to guidance given the way that they're beating, according to their views, across the board. This business.
My quest continues in terms of why Novo is down as much as it is, because it's got a decent weight, like 2% nearly off on Novo Nordisk this morning is some weight to the downside. From one of my good friends and colleagues, some rotation is the best guess after a strong run, but didn't see anything too compelling. The search continues.
Yes,
we will find out if there's anything more to it than that.
Coming up on the programme, a week on from Manic Monday, we will talk to Sebastian Riedler from Bank of America Merrill Lynch about the risks he's watching in equity markets. Are we done with that selling from earlier on in the week? Perhaps not, is his view. We'll get more on that shortly. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome back. This is the opening trade, 30 minutes into Monday's session, and European stocks are bouncing a little this morning, up just 0.3% on the stock 600. London getting the best of some of those gains. Energy stocks not doing too badly. The oil price up above $80 on Brent now, and so energy is one of those sectors doing well. Also insurance and financial services to the upside. We still have a little bit of negativity on healthcare. It's actually being joined by another couple of sectors that are just coming under a little bit of pressure this morning. US futures are pretty flat and mixed after a lot of volatility last week. And that's maybe where we want to start the conversation with Sebastian Radler.
Let's start the conversation with Sebastian Radler. Sebastian Radler has been on the downside in terms of his outlook for European equities for quite some time. Did last week start to maybe provide some proof of concept? Are we starting to see some of the theories that he's been talking about starting to actually become reality? He joins us now around the table. He's the head of European equity strategy at Bank of America Global Research. Good morning.
Morning, Guy.
You've had a downside target for European equities.
There's not been an easy time, and we've been saying the labour market will wobble after the aggressive tightening that you've seen in terms of monetary policy, and I would argue we're now starting to see the first signs of it, and if that continues, there's more downside for the market.
You've got, what is it, 9% more downside from here? Is the risk of the downside on the downside?
I think there's a downside squared, if you want to put it that way, because it assumes that we just get a little bit of labour market weakening, but if history tells us anything, once that starts, it tends to feed on itself, and you typically don't get a little bit of it. So I would say 10% is the base case, but once things get going, it could be more.
And that's European stocks from here, is it?
That's the European equity market, yeah.
And where do we see, which of the sectors are moving most in this situation?
Now, the interesting thing about the sectors is the sectors are far more advanced in pricing the scenario that we're calling for, which admittedly we haven't seen yet. Cyclicals versus defensives hit a 30-year high in April. They're down already 15%, so we only have 5% downside left. But the interesting thing is it's been very bifurcated. Everything that is consumer has already gotten pulverized. Autos, luxury goods, airlines, all of them below the lows that you saw in 2022. Capital goods still very high, banks still very high. They look vulnerable to us if the negative tail scenario starts to materialize.
So banks look vulnerable, but how does that reading on consumers and what stocks in the consumer space have done, how does that fit with all the conversations that we have with CEOs who tell us the US economy just doesn't feel like it's in a recession right now or heading in that direction?
If we are right, we are very late cycle right now. Late cycle means the unemployment rate is low, the savings ratio is low, demand is still very strong, but you see the first signs of things starting to roll over. And the telltale sign of the late cycle is that the data becomes very amorphous and very hazy. So we see very conflicting signals. Consumer confidence in the US has crashed. It already tells you there's a sharp slowdown. Look at the Q2 results in Europe and the US. A lot of companies are telling us, the consumer is getting weaker. You saw the McDonald's result, first negative sales growth since 2020. And on the other hand, we still see top down. If you look at the GDP data, it's still holding up. It's very ambiguous. It's very hazy. But if history is any guide, we know which way it's going to go.
The stock 600 is exactly at 500 right now. 10% downside takes us down. Let's get into the mid 450s. How much lower could it go? How much of the huge ramp up that we've seen in global equities gets unwound during the down phase here? Do we go back down to levels we saw coming out of the pandemic? Do we kind of completely retrace? What are you thinking about in terms of the way the downslope works?
I think it's a super interesting question, especially given that there have been so many gains. And a lot of people are now starting, we see it in the fund manager survey, which we publish once a month. People start to think about, what do I have to log in? How low could it go? The best gauge is the US high yield credit spread. These are global risk premia. When everything is fantastic, you had 300 basis points. Now you're at 350 basis points.
350, 400,
In a typical recession, you go to 1,000 basis points. Now, you could argue the credit market is better this time around, better leverage, better ratings. Maybe you only go to 700. That's the argument from our credit strategists in the US. So if you go from 300 to 500, with our base case, it's 10%. If you go from 300 to 700, it's 20%. If you go to the 1,000 that you have gone to every single hard landing, then it's 35%. So this is the best way to
European equities or US equities?
European equities highly correlated to the US high yield credit spread.
Okay, and what does that tell us about the broader economy? That's a warning signal that if high yield is coming under a huge amount of pressure, it doesn't just stay contained in high yield and it spreads.
No, I would actually say it's the other way around. Think about it like a fever curve. The high yield credit spread tells you how well the economy is doing. If the economy doesn't roll over, it's basically the economy moves first, and then the high yield credit spread just shows you what's going on. If the economy holds up, if the unemployment rate stays at 4%, this is a soft landing, this is the first time that we have low unemployment permanently without it basically rolling over, then the credit spread doesn't do anything and our thesis is wrong. If the labor market rolls over, you will see the immediate impact in terms of credit spreads widening, and then it feeds into cyclical underperformance, financials underperformance, and the equity market going down.
Is there anywhere to hide in that kind of process?
I think treasuries look very attractive. There's across the board, if you listen to our global strategists.
The equity guys talking about
I know, I just flicked back to the front of my notes going, I'm sure these are equity conversations we're supposed to be having here.
But I thought to make it fun, I thought we always make it cross.
I always make fun. Okay.
In that scenario, you will see wider risk premia, but lower rates. And we've seen really a little proof of concept, I think is really the right term. The moment you got the payrolls report, immediately we went down on the treasury yield, 70, 80 basis points. But you're still pricing a Fed that will not even get back to neutral. So if the labor market wobbles, the consumer gets weaker, especially with inflation fading, there's a lot more scope for the central bank to become dovish. So it basically means treasuries will do well and gold will do well because gold is highly sensitive to moves in real bond yields. In the equity market, because you want me to be an equity strategist, look at staples. Food and beverages down 30% relative to the market over the last 2 years. Cheapest sector in the market, highly sensitive to credit spreads. There's a lot of upside. I would say it's a once-in-a-generation buying opportunity to pick it up at these levels if the labor market starts to roll over.
If the labor market starts to roll over, okay. But super sensitive to credit spreads, but in a reverse.
Exactly.
Right.
In a positive. The higher they go, they got completely beaten up as credit spreads went to an all-time low. Now you pick them up basically with credit spreads. Credit spreads have only one way to go. The moment they go there, staples will do well.
What about other investment themes that we've talked to lots of equity investors about over recent months and years? Is there any sense that any of them have sort of structural potential through the cycle? I mean, maybe not AI, because that seems to be, or maybe AI, I don't know. But what about, grid electrification and all of that sort of stuff?
I think all of these things, and I would even say I would be very positive on AI over the next 3 to 4 years. I mean, maybe I've started to drink the Kool-Aid, but it's very hard for me to see how that is not transformational. We've seen so many powerful application cases. The problem was the market was pricing for this to boost productivity growth right now over the next 6 months. nothing in the history of technological adoption tells you that's plausible. It takes 3-4 years for this to be adopted. I would still like the medium-term outlook. And then if you think about data centers that hang on that, electrification, the green economy, all of this is very attractive. But the problem is the themes and the place on this. Effectively in Europe, that's capital goods. They're already the most expensive sector in the market. They are allergic to credit spreads widening. So I would say it's not the right moment to engage in that trade.
How much is politics going to introduce into this story? What does volatility look like as a result of the US election? There's still a lot of unresolved issues here in Europe as well.
Yeah. So if you look at the betting markets right now, for the first time we've got a lead for the Democratic candidate. To simplify the situation, I would say the Democratic candidate is basically the status quo. That's basically the legacy. It basically doesn't introduce a lot of policy shifts. Now, if you get Trump winning, at the moment the betting markets have him down. It's roughly 46. There's a great function on Bloomberg, which I recommend, WSL election, strongly recommended. Where you can follow all these odds. If Trump wins, there was a big discussion. What actually is the Trump trade? Is it a stronger dollar? No, he pushed back against it. I think the risk is if you get Trump, it could be another inflation shock because all the policies he has, they're effectively inflation.
So a higher terminal rate from the Fed.
It basically means potentially the Fed is in a bind if the economy weakens, but you get basically more of an inflation shock because you crack down on immigration, you impose more tariffs, and then you basically have a Fed that is far more constrained, and it's an upside risk, effectively, the bond yield, relative to that call that I just made for bond yields to decline.
If you're wondering what that function looks like, that's what it looks like.
There you go. Sebastian calls for the function, and the team puts it on air. Very nice. Sebastian, if we've been around the world a little bit, but with your European equity hat on, what are you looking for from China? Because China doesn't seem to have been the story that's moved anything.
I think it's so well observed.
And yet we've got data, a lot of data coming out this week. Any chance it can change the narrative, or are we still sort of asleep on that story?
I think you're really putting your finger on something very important. For the last 10 years, it was China basically driving the global narrative. And it feels a little bit that China has gone the way of Japan, i.e. it's been sidelined, it's been a little bit isolated, and it's no longer so relevant for the global narrative. Where you really see it in the European equity market is mining. Mining has been a huge underperformer because it has caught the China vibe, which has been very negative. Ironically, we would be more positive on China on a relative basis because we are so respectful of the lagged impact of monetary tightening, which you're now digesting in the US, and you start to see the unemployment rate up 90 basis points. You see it in Europe. Look how Germany looks. You can basically the economy cannot basically improve. China is the only major region where you're not digesting a huge monetary tightening effort with a lag. So we think the whole global picture will be weak because everything hangs on the US, but China we think will be a relative outperformer. So we like some of the China plays, like luxury goods, for instance.
And when do we see that come through?
So we would expect right now the credit impulse very weak in China. You should now start to see basically an uplift. It's not a big kind of trend-defying turnaround for the global economy, but the PMI could go up, call it 3-4 points. And then luxury goods and the China, maybe even the autos, they're going to breathe more easily because they have been under pressure.
Are the highs in for equities?
I think so.
So there isn't going to be another opportunity to unload. If you want to get out, you need to start thinking about that now. There isn't going to be another...
Well, the one thing I would say, and I think it's something that everybody who's in the market is hugely aware of, it feels enormously ambiguous and hard to read. As one of my clients was joking, so whenever you think you've identified a macro trade, you can be sure that the next two data points are going to go at the other. So therefore, I would think about it in probabilities. I would say 70% probability, maybe 80, that the high is in. There's a good case scenario, which is the labor market holds up for another 3-4 months. The Fed eases, and then you get one last uplift from a lower discount rate. But you have to be extremely lucky, and I think the probability is not higher than, call it, 20-25%.
That's interesting because, yes, if the Fed is cutting, but there's still a little bit of strength in the economy. And it's not cutting because the economy is weak, it's cutting because rates are a bit too tight for where we are. And that gives a different dynamic.
Exactly, and that would be the positive case scenario. But I'm so respectful of historical dynamics. If you say this would be a scenario where the yield curve uninverts without there being macro trouble, and I'm just saying we've never seen it over the last 50 years, you would really have to bet on something that historically you haven't seen, which is theoretically possible. And I say, okay, if you haven't seen it historically, I wouldn't put too high of a probability on it.
But does the process get elongated? Because of the way we've come into this differently, because of the pandemic, because of a bunch of factors, is the end of this cycle harder or easier to read? Does the process of rolling over take longer? You talk about the Fed being able to maybe to deliver a couple of kind of soft cuts, and we're kind of managing the economic slowdown. If the Fed can manage that turn neatly, Does that change the outcome for asset prices?
So I would say, first of all, is it more elongated? If you think back to all the conversations, Guy, we had over it has been very elongated.
Fair point.
I think now things are starting to move. If it is elongated, it's because you've got so many weird factors, the residual impact of fiscal easing, the boost from immigration, the fact that productivity growth is running higher than normal. With regards to the Fed helping to ease the cycle, in my understanding, monetary policy works with a lag. And there has been a long lag for the hikes that started in early 2022, now to start of the... I'm highly doubtful on the idea that monetary easing is going to work a lot quicker. So they're going to do it, but I think the historical playbook suggests it takes a while for this to come through.
The market prices it in quite quickly, and that's certainly a factor, and the Fed's got a lot of room to move.
The market has priced a lot of Fed easing. What the Fed market would have to price is for this to help the economy. If you get Fed easing, but at the same time the labor market rolling over, you're in the same situation as in the middle of 2008 or at the beginning of 2001, which is the Fed is working to ease, but the labor market rolls over, and you know what the market does.
So rate cuts are bad, not good, is the way we should think about rate cuts.
No, I would say rate cuts are good, as Anna is saying, if they're voluntary, if you do it out of basically out of choice. If you do it out of necessity because you're responding, think about what happened is the labor market weakened and immediately everybody was pricing in a dramatic amount of Fed easing. If you price Fed easing because you see things breaking, net, that's never going to be a positive thing.
Nice to see you as ever. Thanks for stopping by to see us. Sebastian was promising us some jokes about round tables, but we didn't quite get that.
Next time.
Kept me too busy.
Next time. Yeah, we've got things to talk about. Sebastian Radler, Head of European Equity Strategy at Bank of America Global Research. Great to see you. Thanks for stopping by. Up next, we need to talk about some of this data, this hard-to-read data right now. UK CPI data due out this week, likely to give the Bank of England another reason for caution on cuts. It's actually potentially going to tick a little bit higher. We're going to speak to our chief UK economist here at Bloomberg to get a take on what we should be looking at here. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Welcome back to the opening trade, 47 minutes into Monday's session, and it's okay if you didn't appreciate the volatility of last week. You can look at your screens. We do see a bit of upside in stocks. If you like the volatility, well, things look a lot quieter this morning. We're a little bit higher across European equities. US futures actually turning a little more positive as we are going through the early hour of this European session. We're up a couple of tenths of a percent on E-minis and NASDAQ futures now. Let's turn to some of the other data points we'll be watching this week away from US CPI. A raft of UK data is due out this week, and it's likely to keep the Bank of England cautious about how quickly it can cut interest rates this year. Let's talk to Dan Hansen, Chief UK Economist at Bloomberg Economics, with us to discuss. So, good morning to you, Dan. Morning. Lots of data points then from the UK. We've got the usual trio of data points with the labour market data, the price data, CPI and PPI, and then the GDP data as well. I suppose we've got a Bank of England that is cutting rates, but going out of their way to tell us that, you know, we shouldn't expect a lot of cuts in a hurry. So what's the key data point that you're going to be watching for this week then?
It's quite boring, but I'm going to say services inflation. The bank have been quite interesting, the way their reaction function has evolved. I think they've shifted away, I think, a bit from the data and become a little bit more forward-looking in their reaction. Nonetheless, it is very, very difficult to be cutting when services inflation isn't falling down. And we know that CPI is going to pick up, but that's an energy-related point. I think they're going to be really keen to see services inflation come down because remember they looked through, to do the August cut, they looked through a massive upside surprise on services inflation, 0.6 percentage point. So I think that's, if you're going to pick one data point, that's the one.
If they hadn't cut, how much harder would it be to cut now?
I think, we were just discussing this off camera, but I think they would get into a world where headline inflation is on the rise, which we know is going to happen over the next 6 months. And I think the optics of that are really, really difficult, particularly when you're going to do your first one, saying they hadn't cut in August. I think people would look at them and say, you had this window in, to be honest, I think they probably would have done it in June had the election not been there, but they waited till August. People would look back and say there was 2% inflation, services inflation, it was high, but coming down, pay high, coming down. But now we've got headline inflation going back up. And to be honest, the way gas prices have moved recently as well, it's not unthinkable to think you get a 3 handle on headline inflation towards the end of this year, which is just a really difficult situation to be in.
And we're getting a reminder of that from external member of the committee, Catherine Mann, talking to the FT, saying the UK should not be seduced into thinking the battle against inflation is over. I mean, she's somebody who we've heard a lot of hawkish things from in the past. I'm not sure this is new information for the markets, but is that something we keep on our radar?
I think so, and I think, you know, we know this decision in August was finely balanced for the ones that even voted for the cut. You know, most of them said it was finely balanced. So I think Catherine Mann's probably going to be the last hawk standing, if you like. She will continue to bang the drum on this stuff. I mean, one thing for me, actually, it's interesting she picked up on pay growth, because for me, that's the one thing that's probably behaved a little bit better than the bank had expected. And if you look at forward-looking indicators, things like their decision-maker panel, it looks like pay growth is going to head down closer to 4%. And, you know, in the next few data releases, pay is going to fall quite sharply, because of base effects. But she's right, you know, and 4% isn't good enough for 2% inflation in the UK. 3% pay growth is what you need for 2% inflation in the UK. So there's that last mile, if you like, on pay growth.
How big a danger is there that August looks like a mistake?
That's a good question. I don't think it does. I think you'd have to have. I think at 5% you're still pretty restrictive. So I think what you would end up being in a world of is one and done, rather than the idea that, I think the mistake would be the idea that you would not commit, but still be signalling that more cuts are coming, which is what's consistent with their forecast. Yeah, they've got a forecast of rates coming down to 3.5% on the market curve. On the market, inflation undershooting target. So they're telling you 3.5 is not low enough. They need to go further. So actually, I think the mistake isn't necessarily just doing that one in August. It's the idea that setting the market up that there is more to come. The
expectation, yes.
How do we work in the fiscal unknowns here? Because, I mean, they're price takers, aren't they, on this? They have to just price in whatever the government gives them, but the government isn't going to give them anything until quite a bit later in the autumn.
Yeah, so that's going to be something really key for the November report. We know there's going to be almost certainly a fiscal loosening. The announcement that Rachel Reeves set out, it's very hard to imagine that borrowing isn't going to be higher this year. She's not going to find another £16 billion worth of savings this fiscal year. So it's then what comes next. And remember, they've got a 3-year forecast window, and it matters what happens in terms of tax rises over that window and how much that hole is plugged. But I think it's a big thing, and they sort of dismissed it in the press conference, particularly around the pay rise in the public sector. They didn't seem that fussed about it. But no, nonetheless, I think it is a risk, and I think it is something that they're going to be taking on board, and particularly if growth continues to hold up.
Why is growth holding up? Where are the drivers? It's the service sector economy. Looks like it's doing quite well at the moment. Yet there are warnings coming. You look at what is happening in travel. You talk to people who work in the hospitality sector. They're starting to see maybe some signs of things certainly softening. I'm not going to say slowing down significantly, but they are certainly softening. Yet at the same time, wages actually remain relatively elevated. What are the growth drivers, and how sustainable do you think they actually are here right now?
I mean, I viewed the first quarter growth surge, and we're going to get one in the second quarter, by the way, as well. It feels like a bit of a relief rally on the back of a fall in interest rate expectations. Housing investment picked up very sharply. I think the interesting thing, and you've picked up on it there, is that the story this year was meant to be about strong real income growth, consumers driving the recovery. But what we haven't really seen that. Like, consumption it's growing, but it's growing very modestly. The saving rate continues to rise. So actually, that's a story of cautious consumers. If I look at it, the saving rate shouldn't be rising if you're happy about the future, if you feel comfortable. So I think that's a really interesting question in the second half of the year. If consumers turn up, then growth could be extremely strong in the second half of the year. But if that cautious sort of higher saving continues, then I think we will get this step down, and that it will look like a relief rally in the first sort of couple of months of the year, and they're the two sort of strong figures in Q1 and Q2 that we're likely to get.
Dan, great to see you. Thanks for stopping by to see us and update us. We've got some big data coming up. We're going to be monitoring this story throughout the week, bringing you back to the data. Dan and the team doing some great analysis on what we're looking at here, joining us from Bloomberg Economics. What do we got out for the rest of the week? This week's kind of interesting. There are some really interesting things. So you got the OPEC story, which I think is going to be well worth watching. You got the US data, UK unemployment data. We'll vaguely keep an eye on that. PPI is the number that you definitely want to watch out for, because that's got some quite useful lead indicators into PCE. But actually, I think the corporates are really interesting this week.
Yeah.
You look at some of the names we've got out. UBS is out, Walmart is out, Baba's out, JD.com is out. All of these things are going to be coming out throughout the week. India's interesting as well. UMISH Friday is going to be interesting. Joanna Shu's data is going to be fascinating to watch. But I'm quite focused on some of these corporates.
Yeah. They're sort of giants within their field, aren't they?
Yeah.
I mean, certainly UBS, Walmart, these are, some of the corporates listed or based in China. They're giants in their field, and therefore they can tell you interesting things about the macro. And you combine that with the UMISH number we'll get on Friday about the US consumer. So, there's a danger. We learned quite a lot this week about the consumer strength in the US, or lack of it. And I know Dan was talking about the UK, but interesting to think where that narrative goes. I'm interested in the oil story. We do seem to have oil prices on the rise a little this morning, $80 a barrel on Brent now. Oil's kind of steady, but tracking a little bit higher, keeping an eye on the geopolitical risks, and of course waiting for that monthly report from OPEC.
I don't know how much geopolitical is in the price. Geopolitics is in the price there, because in theory other commodities have been softening up a bit. If you got a recession figure, you'd have expected oil to have come down further. It didn't do that. So does that tell you that actually that trade is still on, that actually we are going to be seeing heightened tension in the Middle East? And you bring Iran into that, and in theory the oil price should react quite strongly to that, but I don't know how much is already in.
Yeah, certainly one we'll continue to watch. We'll watch the geopolitics, and we'll watch the demand story and how that plays out in commodities, in oil and the wider commodity space, which I know last week we talked a bit about, didn't we, about some of those base metals and the weakness that we were seeing there. That is it then for the opening trade. We have European stocks up by 0.4% this morning, the FTSE 100 up by 0.6%. US futures, as I mentioned a moment ago, are ticking up a little, up by 0.3% on the futures story. So we could see some upside at the start of what is a much calmer week than last week. Have a good one, everybody. The Pulse is up next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
European stocks rise after last week's volatility as traders wait for a host of economic data over the coming days, including U.S. consumer inflation. Well, foreign investors pull a record amount of money from China last quarter, another warning sign for the world's second largest economy. Plus, a new poll shows Kamala Harris leading Donald Trump in 3 key swing states. We'll bring you the latest on the race for the White House. Now, first thing is first, let's look at the European markets map. Now, again, the focus this week is definitely on a lot of U.S. data. Global stocks, though, seem to be posting some modest gains. This is what we're seeing also in Europe, with the DAX gaining 0.5%, the CAC gaining 0.4%, and then the FTSE 0.6% higher. Now, most European equity sectors trading in the green. Again, this is the 5th day of advances after the crazy volatile week that we had last week. A couple of things that we're watching out for is, of course, concerns that the Fed is waiting for too long to actually cut interest rates and what that means for the global economy. S&P futures 0.2% higher. You can see sterling after we also heard from Catherine Mann, probably the most hawkish on the MPC, 127.71. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, European stocks and U.S. futures are up as traders look ahead to a busy week for economic data for clues on the state of the U.S. economy. Now, Althea Spinozzi, head of fixed income strategy at Saxo Bank, joins us also here as Bloomberg's Justina Lee. So thank you both for joining us. Althea, let's start with you. Last week was actually quite crazy. Now we're seeing a lot more of calmness on the markets, but actually, I guess a good thing about last week is that fixed income behaved in a way that's more traditional, that was meant to do.
Well, Francine, I think that the volatility that we have seen last week was surrounding the unwinding of the Japanese carry trade. And also, we cannot forget that we are in the middle of summer, so there is very little volatility, very little liquidity in markets currently. So we started the week with recession fears. We ended the week with the market being a little bit more objective and understanding that maybe we are not that close to a recession. And actually, the big problem ahead are the U.S. elections and a possible reacceleration of the economy. You see, Francine, I believe that it's true that there is a slowdown of the U.S. economy, but weakness is focused on very particular sectors in consumer staples, apparel, and restaurants. But the rest of the economy is going fairly well. We can see that also from the earnings reports. If we exclude from the Standard & Poor, the Magnificent Seven, the rest of the companies are set to grow 7% compared to last year's after quarters of declines. So we have to couple this with the fact that inflation remains at 3%, the economy is growing beyond trend, and the Federal Reserve might be starting to cut rates. That points to a reacceleration of the economy, which is bearish for bonds.
Yeah. Althea, let me also bring in Justina here. Justina, I mean, the last week, again, was pretty incredible to watch, and Althea's right. Part of it was the unwinding of the carry trade. Part of it was, I think, just panic on the Magnificent Seven and actually concerns about the U.S. economy. Are we going to see wobbles ahead or after that CPI print on Wednesday?
Yeah, that really is going to be crucial there. And right now, economists are expecting a slight acceleration, but nothing to really alarm traders. And I think the key here is not really whether we're going to get a rate cut in September. I think it will need to be a huge upside surprise to change that. But I think the key here is, are we going to get that 50 basis point cut? What does this mean for the trajectory? Because right now, money markets are pricing in 100 basis points of cuts by the end of this year. And so kind of depending on where the CPI number lands relative to expectations, I think that's what markets will be looking for.
Althea, am I right in thinking that you think the markets are ahead of themselves? I mean, you anticipate a 25 basis point rate cut in September by the Fed, and then possibly just one more until the end of the year.
Absolutely. I think that at this point, bond futures are indicating the possibility of a 50 basis points rate cut by September. And I believe that it's more probable to have no rate cut rather than a 50 basis points rate cut. So eventually, Francine, markets will need to push back on what is priced in terms of interest rate expectations, and that's bearish for U.S. Treasuries. I really believe that the fair value of 10-year U.S. Treasuries is between 4.5% and 5%. And the reason being is that the term premium remain negative, and we need that to rise in order to better compensate investors for the risk of inflation to remain sticky and elevated.
And Justina, Althea also points to the fact that actually there's been localized weakness, that there's weakness that's pretty sector specific. Do you think, Justina, that the recession fears have been overblown?
I think so. I think by the end of last week, people have woken up to the fact that it's not that a recession is imminent, but I think people are kind of looking at the weaknesses in manufacturing, for instance, and of course, the uptick in the unemployment rate. But even there, everyone was talking about the Somme roll last week, but even there, even the Claudia Somme herself has said that it might not be as indicative this time. Is the unemployment rate kind of ticking up about, the weakening demand? Or is it just about a surge in supply from, immigration, for instance? And so I think people are kind of parsing these different strands here. But what seems clear is we don't have to worry about a severe slowdown just yet.
And so, Althea, how do you play treasuries right now? What part of the market or what part of the yield curve do you buy into?
I remain very cautious, Francine. I really like the front part of the yield curve up to 5 years. And you see, with 2-year U.S. Treasuries, it's almost impossible to lose money. You need yields to rise beyond 8% in order to get them in the red within a year of holding period. But because the term premium remains negative, it's very hard to get too far the duration curve. I really like also selective corporate bonds, especially in the high yield corporate space. And the reason is that we have seen spreads widening last week, and there are some junk bonds that are now paying an interesting yield and have been able to refinance their debt beyond 2026. These are the kind of instruments that I believe are interesting because are providing a buffer against inflation. So in short, Francine, what we are seeing today is a replication of the theme that we have seen throughout 2022 and 2023. Its yield is important. We need to create a buffer against the risk of sticky inflation and central banks not to deliver on interest rate cuts.
Justina, when does the focus move to China more?
I think it is this week. You know, we've got kind of a spate of data coming out of China, and it's kind of coming at an interesting point because we've got news recently that the Chinese authorities have been kind of giving guidance to the brokerages, telling them to halt the bond rally. They think it's gone too far. But the problem is, like, people are buying bonds because they're worried about the economy. And kind of in that lens, we're going to get, you know, the money supply data, industrial production, retail sales. And I think it's going to tell you whether the momentum really is turning here, because obviously we've been worried about Chinese consumer demand. But at the same time, I mean, if the U.S. economy is slowing, that's going to hurt the export engine as well. And so you kind of have a bit of a double whammy there if they're unable to kind of turn consumer spending around.
And Althea, when's the right time to start thinking also about, you know, the U.S. election, what that means in terms of fiscal deficit, what that means to the yield curve, also because of the tension between U.S. and China?
I believe that it's important to think about it right now. We have two candidates, and both of them look like they are not scaling back on fiscal spending. In the case of Trump victory, we are going to have a higher geopolitical risk, and he's going to implement steeper tariffs against China that will put upward pressure on inflation. So when I look at the U.S. election, really, Francine, I really look at the risk of inflation to be to remain, and really for the yield curve to remain inverted for longer, because the Federal Reserve would not be able to begin a sustainable interest rate cutting cycle.
Althea, thank you so much. Althea Spinozzi, Head of Fixed Income Strategy at Saxo Bank, and Bloomberg's Justina Lee. With all this volatility, I keep on losing my voice. Now, coming up, a rush for the exit. Foreign investors pulled $15 billion from China in the second quarter as concerns remain about the health of Asia's biggest economy. We'll discuss that next, and this is Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now to China, where foreign investors pulled out a record amount of money, $15 billion last quarter. Now, if the decline were to continue for the rest of the year, it would be China's first annual net outflow since 1990. Now, foreign investment into China has slumped in recent years after hitting a record in 2021. When James Mager, our senior reporter on the Chinese economy and government, now joins us. So, James, great to have you with us today. So what does the data actually show us, and what's driving the drop in foreign investment into China?
I think what you're seeing is in a continuation of last year's really weak numbers. We saw a record, there was a record low, it was like about a 30-year low last year in companies putting money into China. And this year you're seeing a continuation of that. Basically, yields obviously are much higher in the US and other developed economies than they are in China. The Chinese central bank is cutting rates now. And so if you're a foreign company, you're looking at a weak Chinese economy, you're looking at growth, it's not even going to be 5% this year, it's only about 5%. And then you look across the Pacific to the US, where you can get 5% just by having your money in treasuries, you see a better investment environment. So companies are taking their profits and they're moving them offshore. And then you're also seeing a lot of foreign companies, especially in the car space, are pulling out of China or cutting back their investments in China because they're just not able to compete in the Chinese market against companies like BYD anymore. So you've seen Mitsubishi pull out, where you saw Honda was cutting back, Nissan is cutting back, Hyundai is cutting back. A lot of the foreign brands, which were doing really, really well in China until just a few years ago, are now really pulling back on their investments there, and that's also driving, driving these numbers and this, this drop we saw in the second quarter.
James, Chinese firms are also investing overseas at a record pace. So what's driving that?
I think it's the opposite of that. It's these very, very strong Chinese car companies and battery companies which are really driving this record $71 billion in outbound investment we saw in the second quarter. BYD has opened factories in Thailand, Brazil. It's opening factories in Turkey. It's talking about opening a factory in Hungary. It's opened a factory in Kazakhstan. You've got battery factories that are being opened around the world to supply not only Chinese EVs, but for other companies' EVs as well. You've got Chinese companies building chemical plants in Saudi Arabia and other places. So Chinese companies are going out now in ways they haven't gone out for probably the last 10 years to really try and take advantage of, one, the demand for their goods. Chinese EVs are some of the best in the world. The battery technology is the best in the world. They lead on solar panels. But then also because they're having to build overseas because of higher tariffs. You can't, a lot of the things like EVs, for example, you can't ship from China to the US. The EU has obviously put in tariffs as well. So there's a lot of pressure on Chinese companies to build their factories in Europe or in South America or in America so they can get their goods to customers in those markets.
James, thanks so much. James Mager, there, Bloomberg senior reporter on the Chinese economy and government, joining us this morning. Now, coming up, Disney looks to ramp up its expansion plans by betting big on the bad guys. We'll tell you more after the break. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
U.S. inflation expected to have picked up last month, but not enough to derail the Fed from a widely anticipated interest rate cut in September. Now, for more on all of this, let's bring in Ven Ram from Bloomberg MLive. So, Ven, first of all, good morning. What's the bias for Treasuries heading into this week's CPI?
Morning, Francine. I think that the path of least resistance for Treasuries, at least the front end, is to be headed higher because, the markets are thinking that, the expectation, as you mentioned, on the CPI is for a reading of 3%. So the markets are kind of used to this idea that core CPC is going to be around 2.7%, headline inflation and core inflation are going to be around 3%. So if you juxtapose the Fed's policy rate of 5.375 against that, it's clear that it's abundantly clear that the Fed's real policy rate is restrictive at this point, and the Fed is kind of minded about its dual mandate, i.e., it's concerned about the labor market more than it has ever been in the cycle. That means that, a rate cut is to be expected soon. But considering how much the markets rallied last week, I think some correction is due, and that is what we are seeing, which means that the 2-year Treasury yield should head towards 4.20 in the coming days.
Ven, bonds are back as a hedge after failing investors for years. How excited are you about the week that's been?
Well, I think that the 10-year Treasury yield is still south of 4%, and I think that demeanor of the markets is likely to continue because there's going to be this chase for duration. There is increasingly, as we mentioned, the Fed is going to be cutting rates, and these yields are going to looking a lot richer than they've been in the cycle, given how compliant inflation has been, or rather disinflation has been. So I think that the chase here is going to be continued duration in the months ahead.
So, Ven, the BOE's Catherine Mann has also this morning warned against complacency about inflation, but she's the ultra hawk. I mean, we get CPI reading out of the UK this week. Does it complicate things for the Bank of England, or do we just need to remember she's the ultra hawk?
Well, I think that, the BOE kind of crossed the Rubicon, as it were, on earlier this month when they cut rates. Now, typically, central banks are most reluctant at the inflection point of the cycle, i.e. when they are about to raise rates or when they are about to cut rates for the first time in the cycle. That has already happened earlier in August. So I think that the bar for further rate cuts is much lower than it was previously. And therefore, I think that even with a mild uptick in inflation in the coming months, I think that the BOE has shown to us that they're very keen to lower the policy rate to take it to less restrictive levels, and which is why I think that the bias is for gilt yields to rally from here.
Ven, as always, thank you so much. Ven Ram there with some great insight from our Bloomberg MLive, where he's a strategist. Now, on to corporate news, and Walt Disney has unveiled a number of new theme park attractions as it looks to expand its resorts business. Now, these will include an area devoted to movie villains and a doubling of its Avengers campus in California. Now, last September, Disney announced long-term plans for its parks and resorts that included investment of around $60 billion over the next 10 years. Well, Charlie Wells from Bloomberg News joins us. Charlie, this is exciting for us Disney lovers, but when you look at, the villains, can they actually align this to make sure that investors are happy with returns?
Yeah, well, the villains may come to actually save the day for Disney in this case. They're just a little bit misunderstood. And basically, Wall Street has been looking for some specifics on this plan for a long time. Yeah. So actually, when the company announced that $60 billion plan of investment last year, Disney's share price actually fell because investors wanted to know exactly how they were going to spend that money. So this is what we're finally getting here. We're getting, the largest expansion at the Magic Kingdom in its history, a lot in Shanghai and Hong Kong, and even in Paris down the road, a Lion King themed ride, which should be a lot of fun.
Yeah, it sounds like a lot of fun. So what are the risks of park expansion at a time where consumers are kind of feeling the pinch and ticket prices can't go up too much?
Yeah, so this is sort of an inopportune time for this announcement to come, actually, because Disney's earnings report recently showed some softness. So consumers on that lower end in the U.S. kind of pushing back on the ticket pricing, and then consumers on the higher end traveling abroad. And so they find themselves in a difficult point right now. But of course, these are long-term capital investments, which should pay dividends for them over time.
So when do we know if the strategy is working?
I mean, look, it could take a while, but I think for Disney, this is really crucial. And experiences, in 2023, they formed 70% of operating income, so a big part of the business. And at a time when other media companies are really struggling with that terrestrial lag and sort of their cable properties, it's really important for Disney to have this diversification.
So what can you tell us? I mean, when you look at their strategy, resorts has been doing quite well, especially if you're expecting a lot of investments. But actually subscriptions and I guess streaming has been dodgier?
Oh, it has. And I think actually, it's all about content for this company. And in their earnings report, for the first time, their streaming platform was actually profitable. But that took a long, long time. And really, it ties into content and bringing it back to diversification.
Thank you so much, Charlie Wells, there with the very latest on Disney. You see dodgier, that's like CFA level 6. Welcome to August, everyone. This is a picture for U.S. futures across the board. We've had a very difficult week last week because of all the volatility, mainly because of the unwinding of the carry trade, but frankly also concerns about what the Fed does next. Now, global stocks at the moment seeing modest gains. Traders preparing for a week packed with U.S. data that should shed some lights on the health of the world's largest economy, but also the outlook for Fed interest rates. Coming up, Vice President Kamala Harris has energized the Democratic ticket and swing state voters. That's according to a new poll. We get the latest on the race for the White House next. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It
it's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. These are your top stories. European stocks rising after last week's volatility as traders wait for a host of economic data over the coming days, including U.S. consumer inflation. Foreign investors pull a record amount of money from China last quarter, another warning sign for the world's second largest economy. Plus, a new poll shows that Kamala Harris, leading Donald Trump in 3 key swing states, will bring you the latest on the race for the White House. Let's get straight into U.S. politics, and that's after the New York Times Siena poll. Now, for more, let's bring in Tina Fordham from Fordham Global Foresight. Tina, thank you for joining us. Look, it's quite an incredible, energized, 10 days since Kamala Harris appointed her VP candidate. I don't know what you've learned and how surprised you are by the polls right now.
It's a remarkable turnaround. It's a reminder that using polling data to extrapolate the future wouldn't have brought you this kind of insight. I've been saying all year this is an extraordinary race with so many wild cards and so many unusual variables it wouldn't follow the playbook. But even so, no one expected, I think, to see the energy that the Harris-Walz ticket has brought to bear.
How do you explain this energy? So is it a flawed vice presidential candidate on the Trump side, or is it really? I mean, I guess the big question is, can Tim Walz actually gain a lot of the swing states?
So what they brought to the ticket, I think, is an opportunity for people to abandon their previous positions. It seems to me, I mean, we have the same U.S. economy now that we did 3 weeks ago. No. So the U.S. economy hasn't changed much, and that's a reminder to market participants who really tend to be quite economically deterministic in their views. Suddenly all of those, talk about inflation and other things have fallen away, and it's not just because of the expected Fed rate cut. I think that people see an opportunity to be part of something. People are talking about how this is like Obama. I think it actually reminds me of the first Clinton campaign with the energy. And it's not focus group. This messaging isn't feeling canned.
So let's also bring in Ross Matheson, Bloomberg's EMEA news director. Ross, I guess the question is, the 5th of November is still a long time away. So can the Democrats continue with this energy, and can they continue doing quite well in the polls?
What's interesting, as Tina was saying, she has momentum and she's raising money. She's out campaigning aggressively, and she seems to be resonating along with her running mate, and that's got the Trump camp, quite scared. It seemed at this point they're trying to regroup their campaign, and we'll see that later today. Obviously, when Donald Trump sits down on Twitter with Elon Musk and has his unfettered interview. But the question, as you say, is continuing to have that momentum, because we will get data points. We got CPI coming in the US this week. And in the end, when voters do go to vote, one thing they tend to vote for is those bread and butter issues of the economy. And they'll want to know from her what are her policies on the economy. We can see she's starting to unroll some of those now, but that's where in the polls Donald Trump is still polling a little bit ahead, is that he's seen as a better steward of the economy and better placed to deal with immigration issues. She's seen as better placed to deal with other issues that voters care about. But those are two where he is still a little bit in front in the polls, and so she really needs to put some specifics out on what her economic policies will be, because that's something before, you know, as vice president and a politician for many years, she's not had to present that much on. And so that's one area where she's a little bit untested. And so that's something where, you know, alongside that momentum, and it seems to be quite natural as well, as Tina was saying, she does have to come out with some proper policies.
But so, Roz, how much of this election is actually being fought on the internet or on social media, and how much of it is actually in-person rallies? And it feels at times that it's much more about culture wars than it is about the economy that people will vote on.
And it is, and people, obviously it's interesting to see the campaigning that's happening in these swing states, because it does feel like it's gone back to kind of face-to-face, bit grassroots, and quite personal. So you're personalising your message wherever you're going. And so you're talking, you know, to these large crowds, but you're also talking to smaller groups in these places. And obviously the internet plays an important part in that, how much you're using in your social media campaigning. That's where I guess you can get traction on things like disinformation that you might be getting propagated, or claims that you're making. I mean, they're all making up new nicknames for each other to call each other, and that's where that kind of gets disseminated. But in terms of talking to people directly, that does seem to be something that they've seized on, you know, the Harris-Walz camp as doing, because people want to hear from politicians directly.
How do you see this campaign kind of, you know, changing with so we are expecting Elon Musk to interview Donald Trump a little bit later on X, but does, you know, the Trump camp have to regroup and rethink their strategy now that they have a new ticket on the other side?
Absolutely, and they're not prepared. They were caught completely flat-footed by Biden's departure, and Harris is taking on the nomination. You can see that Trump is quite bitter about having to come up with a new strategy, and they haven't really come up with one. They've been trading insults, but I disagree with Roz a little bit about the need to come up with policy positions. Yes, eventually, but for now, this strategy is working really well for Harris and Walz, and they're not only, you know, they're breaking records in raising money, and mainly with small dollar donors. You know, it's not huge corporate donations, and you can see that grassroots, you know, a lot of talk about a vibe. In terms of momentum, we've got some key dates coming up, right? So the Democratic National Convention starts this week. Interviews are now scheduled or about to be scheduled for the end of August. And we're either going to have one or two or maybe three debates, September 10th being the first one. And don't forget that early voting starts in America much sooner than people realize. We're not just waiting for November 5th. In some states, they can start in October.
I mean, there's a great piece actually on Bloomberg Opinion, which I really enjoyed reading, by Francis Wilkinson, talking about Kamala Harris's running mate and his traditional manly traits, and the fact that actually that probably scares Republicans, and that means that they need to change tack. At the end of the day, Roz, it's what, 200, 300,000 voters that they need to focus on swing states. What polls, how does their strategy kind of zone in on that?
Well, that's right. So it's picking, it is always a mathematical calculation, and that's what also went into Harris's selection of her running mate. You look at what states you need to win, where are the voters in those states that you need to win, and how do you get the mix of people to ensure that that math kind of plays out. And, you know, so it was very much a calculated move by Harris to pick Tim Walz. She had a selection, obviously, of candidates who could have also helped with those key states, but she zoned in on someone specifically because of that and as a good pair for her. So it was a really tactical move to have done that. So now they need to go out again to those specific voters, and that's why this effort to go and talk directly to them, you know, face to face, and to say, I'm listening to your concerns, I'm hearing them, and this is what I'm doing about them, versus shouting at you on social media. It could be a really good tactic for her, because it will come down to a specific number of voters in a specific number of states.
Tina, there are rumors that, of course, Donald Trump regrets picking his vice president, given, I mean, he didn't know at the time that it'd be Kamala Harris, that actually there's just flawed in that candidate. Can he replace him, or is that it?
So procedurally, he can't exactly replace, but, you know, he could force Vance out. You know, in politics, it's the art of the possible, as we always say. Vance has been left holding the bag while Trump retreats to Mar-a-Lago and tweets and holds press conferences from there. Trump isn't on the campaign trail right now. Vance was on all the U.S. Sunday morning talk shows yesterday, and somebody said that he sounds like a blogger. And I think that that's quite a useful way of thinking about this.
Is that a good thing or a bad thing?
Well, the cat lady remarks and this sort of thing, this is landing punches. In terms of what Harris and Waltz are doing, as an American, let me add a little bit of color to this. You know, they've put out, for example, some, you know, branded products. Trump has his metallic trainers. They've got some camo-themed beer holders or drink holders and baseball hats. Now, what is that saying? That's appealing to Waltz, who is a hunter, former artilleryman and the Army, but rebranding those kind of American patriotic values for Democrats. Republicans have long held the ground on freedom, on the Second Amendment, gun rights, and these sorts of things. So what's happening with Harris and Waltz is really interesting from my perspective.
Because they're trying to go broader, basically, Roz, and I guess regaining some of that, you know, masculinity that maybe the Republicans tried to own for a very long time.
Yeah.
Well, very much so. I mean, they're trying to say that you can vote for us and we represent these views and we represent you as an American, and this is not just Republican territory. As Tina was saying, you know, they're being careful on gun rights and so on. And one area that she's been very strong on, though, and this appeals to women as a whole generally, is abortion. And that's where Trump obviously polls very badly. And she's got a very strong position on that. So she's not afraid to take strong positions when she needs to. And that's something that she has done, you know, repeatedly when it comes to abortion. And so that will target, you know, women voters in particular across the spectrum as well. And so that's a very tactical move on her part. So she is trying to broadly appeal. You know, she's trying to say, as Tina was saying, we can represent you as well as Democrats, but also these are things that we particularly believe in and think are important. And that's where abortion for her could be a good vote winner.
Roz and Tina, thank you so much. Tina Fordham and Roz Matheson both stay with us. Now, coming up, Hamas responds to calls for a new round of ceasefire talks with Israel due to begin this week. We'll have the details next. And this is Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
The conversations that matter, the insights you need. This is A Pulse and Francie Lacqua here in London. Now, Hamas is calling for a plan to implement a ceasefire with Israel instead of a new round of talks. Meanwhile, Israel says an airstrike that killed about 100 people at a school in Gaza targeted a Hamas command center. Well, Stuart Livingston-Wallace, Bloomberg's head of Middle East and North Africa, joins us now from Dubai. Stuart, thank you for joining us. So a new round of ceasefire talks due to take place on Thursday. What exactly are the chances of success?
I mean, I think much the same as previously, in the sense that we've had positive rhetoric, particularly from the US administration over the last several months, and of course nothing has materialized. However, we are getting to the stage now where the hostilities in Gaza, yes, they're ongoing, and yes, there continue to be, very significant incidents like we saw over the weekend, but in terms of the scale of the assault, that has definitely died down, and you're seeing, to some extent, a redeployment back within Israel. So from Israel's perspective, they do appear to be making a lot of gains in terms of their objectives, that is with destroying the Hamas leadership. However, it is very much not mission accomplished. On the other hand, you're now getting this intense pressure, intense diplomatic effort, and the threat of Iran being drawn directly into the conflict. Under that scenario, it may make sense at this stage for Israel to agree to some sort of ceasefire deal. Now, whether that will hold, as we saw several months ago, where it kind of fell apart after a few days, remains to be seen. But I think there is a certain amount of appetite there.
What's the international community, Stuart, saying after more and more civilians are getting killed in Gaza?
I mean, I think the focus, again, is on de-escalation. So I sort of point everyone to what's been happening in the aftermath of the assassination that we saw in South Beirut and the one we saw in Tehran. Now, particularly the one in Tehran, because it was so deeply embarrassing to the Iranian regime. And previously, with the exception of that one incident in April where Iran sent rockets and drones directly at Israel, by and large, it's operated through its proxies, which are more or less surrounding Israel. So in Yemen, Lebanon, Syria, Iraq, and of course in Gaza itself. What that assassination did was effectively provoke Iran into needing to retaliate of some sort, and that in turn started this cascade of diplomatic efforts that you saw from world leaders to try and simmer things down. And all of that is pointing to potentially something at the ceasefire talks that we're expecting on Thursday. Now, quite where they're going to take place, we don't know. Probably Doha, could be Cairo, but again, we've got a couple of days to see where they can actually meet up and see if they can make any headway this time.
Stuart, thank you so much. Stuart Livingston-Wallace there, Bloomberg's head of Middle East and North Africa. Now let's bring back Tina Fordham, founder and geopolitical strategist at Fordham Global Foresight, and Rosalind Matheson, Bloomberg's EMEA news director. So when you look at the U.S. race, actually, for the elections, Ros, does foreign policy come into their thinking? I know Kamala Harris has been doorstepped many times, especially as we have more civilian deaths, but just trying to figure out what, if she were in charge, what the Middle East policy would be.
Well, it does matter a bit for the US election because it matters to some of the voting bases in the US. People have strong views. Either they support Israel quite strongly in this, or they might be very pro-Palestine. And so in some key states, there are strong bases of voters that she needs to tread carefully with. I mean, we saw that in some of the calculations again about her vice presidential pick. And meanwhile, separately, you do have, Tim Walz and questions about his views on China. So you can see how this does come in to the conversation, be it China or the Middle East. And so she has to be careful about that. But she's been very strong so far on Israel. She said, I wouldn't stop shipments of weapons to Israel either. She, defending, Israel's right to defend itself while expressing concern, like Joe Biden, about the humanitarian situation inside Gaza. So she's kind of hewed to the established policy of the Democratic Party so far when it comes to that. So for the election, it may matter a bit, but then the question is if she's president come next year and this war is still going and the conflict in Ukraine is still going, we've got tensions with China, over Taiwan, but China itself, she'll have a lot on her plate when it comes to foreign policy, and she is a bit untested on that front.
How do you see the Middle East, resolving itself? It feels like there was escalation, but now we're waiting. So it's unclear where this goes, and we're seeing more civilian casualties.
Well, that's right. And that last chance saloon peace conference this week that includes Qatar and Egypt and the United States is going to be very closely watched. Now, the question in my mind is how serious Hamas and Israel are taking this conference, because wars end when one side surrenders, and neither side seems even close, in my view, to surrendering, right? And they're not closer to winning. The Iran retaliation for the Israeli assassinations, the presumed Israeli assassinations, could come as early as today. It's likely to be, I think, strategic. So it might be in a population center, like even Tel Aviv, but against a military target. If there's a mistake or a miscalculation and there are civilian casualties, this kind of escalatory cycle could continue. But there's one key variable, if you let me just say one final thing that I'm watching. And remember that Joe Biden, now that he's unencumbered by seeking re-election, could change his position, could either offer concessions or incentives, whatever it might be, because he's concerned now about his legacy.
But anything he does, would that not actually almost transfer to Kamala Harris in terms of policy? And you don't seem very optimistic about any kind of way forward this week or in the next couple of weeks.
Neither side feels enough pressure, but that's what I'm saying. Biden could turn up the pressure. Harris has to be careful. The one area, though, where she has put a bit of daylight between herself and Biden is on Israel. She doesn't want a DNC with a lot of protesters. And another point, don't forget, the campus protests that were so messy and complicated will probably start up again once school returns in September.
Rose, how do you see the way forward?
Well, as Tina's saying, it's very, very complicated because we have Hamas and Israel saying, yes, we're both interested in a truce, but they're still some way apart. I mean, Hamas says that the starting point for a truce has to be a pathway to a permanent end to the conflict. Israel says, no, any truce has to be temporary and allow us, if need be, as and when we want to resume fighting. That's a fundamental difference. And so there has to be an incentive on both sides, as Tina was saying, to really get towards a ceasefire where either, both sides feel they get something that they wanted and they're not giving too much away in the process. And they don't seem to be there. I mean, we've had so many rounds of talks that have been unsuccessful and not led anywhere. So the question is, where is the momentum coming this week for that to happen? Is it because they truly believe it will ward off retaliation from Iran as a result?
Many questions which we need answers for. Thank you both for joining us. Tina Fordham, a geopolitical strategist at Fordham Global Foresight, and Bloomberg's Rosalind Matheson. Coming up, Ukraine says the Russian army has started a fire at an occupied nuclear plant, while Russia blames a Ukrainian drone for the explosion. We have the details next, and this is Bloomberg.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The International Atomic Energy Agency has demanded immediate access to a nuclear power plant in southern Ukraine in order to assess damage from fire, which Kyiv has blamed on Russia. Now let's get more on the story with Bloomberg's team leader on Russia economy and government, Anthony Halpin, in Dubai. Tony, thank you for joining us. So what's the latest on the nuclear plant?
Well, Russian media is citing Russian sources now saying that this fire is out. Russia blamed a Ukrainian drone for the blaze. Ukraine has blamed Russia. The International Atomic Energy Agency, as you say, is seeking access to the plant. They want to assess damage. And the director of the agency, Rafael Grossi, is calling on both sides to cease what he calls reckless attacks on the plant because of the risk of a nuclear accident. This is Europe's largest nuclear plant. It's been under Russian occupation since very early in the war, and it's close to frontline conflict between the two sides. So it's a vulnerable site, and as you see, there's the potential always for some sort of accident there.
So what's happening with the Ukrainian incursion into Russia, and how is Russia responding to that, Tony?
Yeah, Russia is still struggling to regain control of its border. It hasn't managed to expel Ukrainian forces. There's some evidence that it's spreading into a neighboring region called Belgorod. The local officials there started ordering people to leave border regions this morning. And Russia is rushing reinforcements, tanks, men, artillery to try and halt this invasion. It's very embarrassing for the Kremlin that Ukraine has managed to enter its territory. It somewhat breaks Vladimir Putin's image as a leader able to protect Russians, because there are tens of thousands of Russians now fleeing their homes in that region, and Russia is still struggling to regain control.
Tony, thank you so much. Tony Halpin there, Bloomberg's team leader on Russia economy and government. Now, quickly, let's just look at the markets, because global stocks have been posting some pretty modest gains. Traders preparing for a week packed with U.S. data that will shed light on the health of the world's largest economy, but also on the outlook, we hope, for Federal Reserve interest rates. There's been some relief, certainly, from the volatility that we saw last week that ripped through markets on Monday and Tuesday. Up next, Bloomberg Brief, and this is Bloomberg.
about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, you know, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set your agenda. Volatility recedes. Risk finds its footing for now as global turmoil drives U.S. money market assets to all-time highs. Not so fast. Governor Michelle Bowman sees upside inflation risk as markets kick off a big week for economic data. And Republican nominee Trump gears up for an interview with Elon Musk, while Democratic nominee Harris leads the former president in the three King swing states. They will be the definition of triumph in this election. There was a wholesale ransacking of risk this time last week. There was an implosion globally, from Japan to the United States of America, and the markets were baying for short, sharp cuts from the Federal Reserve. Here we are, 6 trading days later. This is how we look at the moment, flat on the S&P, but you had some of the most virulent, the best days and the worst days in stocks of 2024. The S&P at the bottom of your screen, 53.71, 50-50 held, the 200-day moving average held. That is the brick in the wall for the technicians. Morgan Stanley this morning are saying you're going to see a bandwidth trade on the S&P 500 between 5,000 and 5,400. That is only 1% on the upside, and that is 6% on the downside. Where we are with bonds, it was a near 36 basis point move from the low to the high. We are incrementally seeing yields drop ever so slightly this Monday morning. Torsten Slok over at Apollo says the Fed pricing is wrong. The Fed pricing is wrong. We're in the same mistake zone that we were at the start of the year. Again, we're counting down to CPI, PPI, and retail sales. CPI will be the very definition of where we are. Dollar yen, I put it there for the board because, again, the epicenter of everything. That's our story today. The epicenter of everything is dollar yen. A week ago, the Nikkei, just look at the bottom of your screen, had its biggest sell-off since 1987. The question you need to ask yourself is whether the trajectory for the dollar, if this is really the correct trajectory for the dollar in the dollar-yen trade. I can tell you this, the short bets against the yen, they're now the least since 2023. Sonia Martin is joining me now. We're going to debate just how much of a washout there's been in the carry trade. But in the meantime, let's bring in our cross-asset strategist, Ven Ram. I'm talking about treasuries. We're waiting for the CPI this week, Ven. When you look at the wholesale ransacking of risk that we had this time last week, how positioned is this bond market? Good morning.
Morning, Manus. I think that the markets have over-latched onto the idea that, the Fed is going to cut rates immediately. They are not going to come out of the emergency, come out and do an emergency rate cut. That much is clearly out of the question. Now, treasuries, the correction in treasuries is running as we speak, and I think that treasury yields are going to go higher in the short term, because what the markets are pricing in, or still pricing in 100 basis points of rate cuts from the Fed by the end of the year. I think they are smoking something that they shouldn't be, and I think that that correction is going to means that treasury yields are going to head higher. Where does that leave us? On the 2-year, possibly at 420 in the short term.
Okay, I mean, that's an accusation to the bond traders that they're smoking something that they shouldn't be. But on a slightly more serious note, there seems to be this very uneasy calm, some of the best days and the worst days of this year in the equity markets, the turnaround in the bond market. Do you think that the sell-off is done for now?
Well, I mean, these tend to happen in waves, Manus, and I think that, it's useful to go back to the pre-2008 financial crisis, when pretty much the central assumption underpinning the humongous rally around that point was that home prices in the US will always keep heading higher. Of course, that movie didn't go to script. We know how that ended with Bear Stearns and a whole lot of other financial institutions going belly up. Now, we are not nearly in the same situation in terms of how dire the economy is, but the markets are again latching on to this idea that come what may, stocks will rebound. And I think that's a fallacy. Why is that a fallacy? Because the Bank of Japan is going to normalize rates, no matter what the deputy governor said last week. And the Fed is also going to cut rates sooner rather than later. If you combine those two together, it means that the carry trade is less attractive than it was ever before in the cycle, and that only means volatility for the markets.
Yep, it's just a question of how long can dollar-yen sustain itself above the 140, 142 level, Ben. A lot of people are making the fair value call way lower than that. Ben, thank you very much, setting the agenda on risk this Monday morning. My guest today is Sonia Martin, DZ Bank, weighing in on these lingering risks in markets. She writes this: thankfully, markets have calmed down a bit, but the peace seems fragile, especially with a view to the situation in the Middle East, which continues to hover over us as a massive, incalculable risk factor. Sonia, good morning. We'll come back to the Middle East in just a moment, and I understand how incalculable that is, because we just simply don't know what the response from Iran will be and where that goes. But let's focus on the narrative. A week ago, there was a wholesale ransacking of risk. It triggered a Bank of Japan verbal put, and there's this uneasy calm that has come to bear. How uneasy is this calm, and how reliable is that verbal intervention from the BOJ for now?
Well, I mean, the BOJ obviously had a bit of an issue. So for the first time in what seems like forever, they actually made a really gutsy move, and they exceeded market expectations. They delivered a hawkish press conference. And then, of course, last Monday happened, and they were, obviously very nervous after this. We have, as you said, had comments since trying to calm things down. But the forward guidance of the Bank of Japan is clear. They will continue to hike rates. It's just going to be a matter of timing. And obviously, they don't want to encourage further market turbulence. And also, I think one of the concerns will be the exchange rate. It was way too weak some weeks ago. Rapid appreciation is also not in their interest. And of course, a stronger yen, not a strong yen, it's still a weak currency, but a stronger yen does imply a monetary tightening. So they'll be watching that. There'll be more rate hikes, but the timing may have been delayed a bit now, given what's been going on.
Well, we've still got a 30% probability of a hike in November. So if the trajectory for the Bank of Japan is inexorably higher, that presumably means there is a fundamental move that dollar-yen retraces back towards the 140 level. And we're not moving in that direction at the moment. So it's not going to be lockstep, is it?
No, it's not. As you've just mentioned, I think the market was massively long dollar yen, and what we have seen is a significant unwinding of those positions. We are now back in neutral territory. We were at 180,000 contracts on the CME just some weeks ago. It is now down to 11. So that's been a massive unwinding. That's obviously been a major driver in dollar yen in recent weeks. With that out of the way, the BOJ message digested, obviously the momentum is going to slow down. And I think it's going to be much more data dependent. It will depend on what's happening in the US with rates on the dollar. So I think it's, it was a one-way street up. It was a one-way street down for a brief period of time. Now, I think it's going to be more of a volatile sideways movement with a tendency lower. But, I think we have seen the lion's share of the move for now.
Let's just square it away on yen. Where are you targeting in the medium term? Does it break the 140, that sort of big blockbuster number, that 140 level, anytime soon? Or does it take another hike from the Bank of Japan to make that come true?
I think it will probably take another hike from the Bank of Japan, and it may even take more than that. I think ultimately the size of the move in dollar yen will also very much depend on what's happening in the US, because it is the interest rate differential which has really been driving this currency pair. When you take aside that brief moment where we were driven almost entirely by speculative trading, so that has been removed. So now we're back to interest rate differentials, and that will depend on the Fed just as much as it will depend on the BOJ.
We've got a lot to get through in the next couple of minutes, so let's just square away the Fed. I like what Torsten Slok said this morning or over the weekend, and he's talking about the Atlanta Fed, GDP 2.9%, Dallas Fed 2.2%. He says the market is wrong. The market is wrong. The Fed pricing is wrong. The market is making the same mistake it made at the start of the year. And if you look at the volatility last week, 150 basis points of a cut, inter-Fed meeting cut. None of that has come to pass. We've now repriced all of that again. How wrong is the pricing in the Fed at the moment at 4 cuts and change?
I think it's still wrong. Obviously, I have to sort of eat my hat a little bit. We did expect the Fed to have the luxury to wait with rate cuts until after the election. It now seems they'll have to move before that, so September. But, up to 5 cuts by the end of the year with only 3 meetings to go, that seemed, massively excessive. And even now, we're still at 100 basis points. I still think that is too much, because that is assuming that there'll be a 50-point rate cut at some point, which I just don't see the need for. And I do agree with what you just said. The market massively overreacted, and it completely priced the Fed wrong. But, it's obviously going to take a bit of time for this to be priced out. We're looking for the CPI data this week, Jackson Hole next week, and we may need to see some more data, especially the next labor market report, for that to actually, be removed from the market pricing.
Well, Michelle Bowman, I think, is laying some of the hawks table, isn't it? Which is, I'm not at all convinced that now is the time to talk about cuts. She says, I will remain cautious in my approach, considering the adjustments to the current stance of policy. So again, I think we're going to get a little bit more Fed speak, and on the road, the bumpy road to Jackson Hole, it's going to be perhaps the hawks that will still be in there. You talked about the incalculable risks of the Middle East. I think that is a very cogent description of where we are. My question to you would be this. I looked at Euro-Swiss, obviously Swiss making a decade high, and there's more cuts to come from Switzerland. But is Swiss more my haven than yen, given the proclivity of the Bank of Japan to not tolerate excessive levels of volatility? So in this times of political crisis, is Swiss undeniably ground zero for haven, or did the bond market really challenge the FX market for hedge haven?
Well, if you look at what's happened in the Swiss franc, there was definitely a speculation that the SNB was in the market recently with the Swiss franc appreciating. So I think you cannot dismiss the risk here as well. The SNB has absolutely no interest in a very strong appreciation of the franc. Inflation in Switzerland is quite low at the moment. I think the latest reading was around 1.3%. So they do not want a stronger currency. So I think as well here, you have to consider the risk that the central bank will intervene or has already intervened. They haven't confirmed it so far. So I think they're both attractive, but also don't dismiss the dollar. We haven't seen a safe haven flight into the dollar because it was, the whole rate cut story was everywhere. But ultimately, in times of crisis, the dollar has always worked as a safe haven. And I think it would do the same again were things to escalate.
What's going to drive the flow? I get the feeling even from the news flow, the story flow, it's as if, never mind the hedge funds have gone to the Hamptons, I think literally everybody has decamped to the south of France, the Hamptons. I'm here, Danny's here. You know, a few of us are still here. But from a flow perspective, and this goes back to the frivolity of markets. From a flow perspective, what can you tell me as we start out the week, counting down to CPI, counting down to retail sales?
Well, I mean, we all know that August tends to be a market in which, you know, we could see massive volatility simply because the liquidity does tend to be lower. And I think this complete overreaction, panic move, I might say, last week kind of goes to prove that. The problem is also that central banks have been emphasizing very much they are acting very data dependent these days. So what that does is, in addition to maybe thinner liquidity, we are seeing a lot of investors sort of, you know, trading from one data point to the next. And that does also create additional volatility.
Yep, it's certainly going to be volatile. And yet on Friday, I had JP Morgan with me, and they were talking about a 50 basis point cut back to back in September and November, and you just go, wow, I mean, that is chunky. We're going to debate this for quite some time. As you're right, we're going to be very data dependent. Sonia, thank you so much. Setting the agenda on risk this Monday morning, Sonia Martin of DZ Bank. There are other stories trending on your Bloomberg terminal this Monday morning. Adani Group stocks fell after Hindenburg Research accused India's chief market regulator of having conflicts of interest that prevented a probe into fraud allegations made against the conglomerate. In a report published Saturday, Hindenburg said the chairperson of the Securities Exchange Board, that's of India, had investments in the fund structure along with a brother of the billionaire, Gautam Adani. She denied any wrongdoing. Foreign investors pulled a record amount of money from China last quarter, reflecting some pessimism about the world's second largest economy. Should the decline continue for the rest of the year, it would be the first annual net outflow since at least 1990. Bharti Global has agreed to buy about a quarter of BT Group in a deal intended to accelerate the expansion of the British carrier overseas. Bharti is buying stock from Altus UK, and the Indian firm has no intention of buying out the rest of BT, according to the founder. Coming up in the show, we'll bring you the very latest on the race for the White House, including what we know about the upcoming interview between Tesla CEO Elon Musk and the former president, Donald Trump. Later this hour, I catch up with Jack Caffrey of JP Morgan. Why investors should remain calm after last week's volatility. Context matters every day on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Next week, Balance of Power is live in Chicago for the Democratic National Convention.
So we've got a race here, and the sprint begins.
We'll bring you breaking developments.
Vice President Kamala Harris closing the gap with Donald Trump.
And informative analysis, all leading up to special coverage Thursday evening, including Vice President Harris's acceptance speech as the Democratic nominee for president.
As president, I will show Donald Trump what real leadership looks like.
Tune in all next week on Bloomberg Television.
Here's Bloomberg Brief. I'm Manny Scranney in New York. The billionaire owner of X, Elon Musk, said in a post that would have a live conversation with the Republican nominee for president, Donald Trump, live tonight, 8 p.m. Eastern on the platform. Musk put this on X. I'm going to do some system scaling tests tonight and tomorrow in advance of the conversation with @real Donald Trump. And of course, Donald Trump was bounced off X, Twitter, suspended in 2021. There's irony for you. Derek Wallbank is with me, our Bloomberg editor. Derek, good to see you. Here we go. It's going to be a very interesting, no-holds-barred conversation between Trump and Elon Musk. Suitable bedfellows. They believe in the same thing. What do we think? What do you think we're going to get from here? We had an hour's freewheeling at Mar-a-Lago on Friday. What do you think we get tonight from Donald Trump and Elon Musk?
Well, Menace, I think it's going to be really interesting. And part of the thing I think is going to be really interesting is that this is going to be Donald Trump in a very large space with a very friendly interrogator, right? Elon Musk is in Trump's corner in this election. He has had a lot of nice things to say about Donald Trump, many not so nice things to say about Kamala Harris, right? So it's very clear which way he wants these things to go. That's an interesting test for Trump, actually, because sometimes you can be a little bit more guarded with questioners who maybe you think are slightly adversarial or who at the very least are not on your side. Maybe you can let your guard a little bit down more with people who you think are on your side. So that's point one. Point two is that you get somebody like Elon Musk or anybody, you know, who's got a big platform who might be a little unconventional. I'm thinking like your Joe Rogans, your Logan Pauls, your people like that. Those sorts of interviews tend to go into different subjects than we tend to hear about, you know, on your typical Sunday morning political talk show, right? So there's a great chance that we're going to talk about some things that we don't usually talk about, and that it might be in a space where Trump might, you know, think that he's in safer hands, but with a whole bunch of people watching, not just an audience on the right.
Well, this is where it could, you know, get really genuinely interesting in that if Donald Trump goes off script, as many people said he sort of did on Friday afternoon, taking over 40 questions in the space of an hour, that this is where, for example, you know, elections can be made or killed. We're also looking at some of the polling. It's Monday morning. We've had a weekend of coverage and a lot of dissecting of, you know, Kamala Harris, when she needs to do her sit-down interview, et cetera. But let's talk about some of the polls that we have. We've got a New York Times Siena College. Now, this is August the 5th to the 9th. Harris is now at 50%. This is in some of the biggest swing states, Wisconsin, Pennsylvania, and Michigan. And that is in comparison to Trump. So there is a shift in the dial. I mean, like, this is but one poll. Financial Times also going with, you know, they seem to trust Harris more with the economy. Let's deal with the momentum. There's a shift in momentum in the polls, isn't there, Derek?
Yeah, and I think that's the right way to read it, Manus, is it's not where is this in a space of time, but where is this in a growth trajectory, right? And if you look at the Times Siena polls from before Harris became the nominee, you were seeing Donald Trump either leading or tied, and now you're seeing Harris with a slight lead in these states. And look, you know, the simple math of the Electoral College is that if you are a Democrat and you win Wisconsin, Pennsylvania, and Michigan, right, that's pretty much ball game if you can hold on to that lead. So it puts Harris into a pretty good position. It's a very different position than Joe Biden was in, right? You couple that with the fact that she's raised, what, $300 million since she became the presumptive Democratic nominee. She's had tons of volunteers come onto the campaign who weren't there so far. You're putting up a slide of, you know, prediction markets that I'm seeing there. You see that rise that's been there, and you also see a corresponding decline in the Trump trade even including Donald Trump's own listed company, from his highs. It all speaks to the momentum.
It does indeed. And then you got the FT Michigan Ross survey saying she should break with Biden's economic policies. She can redefine herself as her own candidate away from Biden. Derek, thank you very much for making the time. We appreciate it. Derek Wallbank on politics. Good morning from New York.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in?
I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Page news from around the world for you this Monday morning. This is what we've got for you. Financial Times. President Biden's manufacturing renaissance has been delayed. Investors hit the pause button. Some 40% of the U.S. manufacturing investments that were announced in the first half of the implementation of the Inflation Reduction Act have been delayed or paused. Projects totaled about $84 billion. And the New York Times. Tom Cruise jumps off Stade de France stadium roof to pass the baton to Los Angeles. The Hollywood star featured in the Paris closing ceremony with the flag, taking the flag to California. The Red Hot Chili Peppers, Billie Eilish played. There you go. Do your own stunts. I do every day.
think what's happening is we're starting to bring realism into the discussion. I mean, I think understanding the global energy system, the scale of that system, the important role that it plays in everybody's life around the world, and then thinking something that's been built over 150 years, trillions and trillions of dollars of investments that's playing such a critical role in the economies around the world, how you transition out of that system. And I would say transition from a higher carbon emission system to a lower carbon emission system. We started out with a very narrow solution set focused on wind and solar and EVs, and assumed or aspired that that would address the total set of the issue, and it doesn't. We need to be more realistic around, to Patrick's point, there are a lot of solutions that are going to be required. We should stay focused on the problem statement, which is emissions, and reducing those emissions, and less focused on exactly how to achieve that, and let every company, every sector, all technologies compete for the most cost-efficient way to reduce those emissions, and we will make progress much faster, which will mean making today's system more emissions efficient, while we introduce new systems that have lower emissions. And then with time, you will transition and we'll make progress.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rain World Cup. This is a three
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond. From our global headquarters in New York, I'm Manus Cranny. Let's set your agenda this Monday. Volatility recedes. Risk finds its footing for now as global turmoil drives U.S. money market assets to all-time highs. Not so fast. Fed Governor Michelle Bowman sees upside inflation risk as markets kick off a big week of economic data. And Republican nominee Trump gears up for an interview with Elon Musk, while the Democratic nominee Harris leads the former president in 3 swing states. A very good morning to you. How do you feel? 1 week later, there was a wholesale ransacking of risk. You had probably some of the best and the worst days in these equity markets of 2025. The key brick in the wall for S&P 500, 53.75 is where it is now. It never made it into that correction territory as the NASDAQ did. Is 50-50, the 200-day moving average. That is the brick in the wall. We're counting down to the CPI this Wednesday. You're also seeing the largest outflows from equities since September 2023, 12 weeks of outflows. Now, you need to talk about the quality of those outflows, whether it was institutional de-risking or whether it was a much more retail outflow and perhaps risk-off narrative. But either way, these air pockets are something that Evercore Julian Emmanuel says. There are air pockets. 6,000 is still the target. When it comes to the bond market, you had a 36 basis point whip around. In the bond market, we're seeing a little bit of a drop in yields ever so slightly this morning. Torsten Slot makes it very, very clear to Apollo. Fed pricing is wrong. Market is making the same mistake as it made at the start of the year. Then you take the other side. So that's the bid side from Torsten Slot. The offer side is from JP Morgan. 2 back-to-back 50 basis point cuts. So there is a range out there. Dollar yen you're not worried enough. If you're looking at yen, if you're looking at the dollar rising this morning by 0.5%, just a week ago, you had the Nikkei at the bottom of your screen, the biggest drop since 1987. If the Fed are cutting and the BOJ are raising, your medium-term risk in yen is to the upside. In other words, yen travels higher and the dollar travels lower. You just need to debate whether this carry trade, this gargantuan carry trade, has been taken out in size. CFTC data says the shorts are the least since the first quarter of 2023. So there has been some wholesale reduction in that risk. Last week, we saw huge swings across global markets. Equity markets on the S&P 500 logged its best and its worst one-day moves in roughly 2 years. JP Morgan's Jack Caffrey writes this: when you look back on the trading of the past week, we are most likely to realize that what we experienced was lots of noise and not much actual signal. Jack joins me around the desk this morning. So you're right. I mean, the spike in volatility, the wholesale ransacking of risk that took place this time a week ago. I'm amazed we're as sure-footed as we are at the start of this week.
Well, I think we come back through when we look at some of the economic data. In the U.S., at least, it remains somewhat robust. You look through, say, the Atlanta GDP now, it's still printing to 2.8% real GDP in the United States. Inflation perhaps slowing more slowly than the Fed would like, than the bond market would like, than some of my colleagues might like to think. But the travel is in the right direction. So I think you come through that. Earnings emerged fairly okay. The nice news right now, the corporate buyback window reopens with earnings being over. So you can actually start putting something of a bid back into the market. And I think things are okay. More volatile perhaps than they were a week and a half ago, but okay overall.
So it's not fair to put asset management against the bank, but let's put the context around it. I was caught up with your colleagues in the bank side, and it was 50 basis points in September, 50 basis points in November. How important is that to the floor? If you talk about buybacks, Manus will give me a bit of a floor. Earnings are a floor. GDP is grand. So how important is it that this cutting cycle begins and it goes in that kind of rapidity and size?
Yeah, I think if you tell me that you're going to see 250s in short order, you come back to that second order question. What is the Fed suddenly seeing? What data do they have that we do not see on a real-time basis? And I think if I can wind back the clock, wish I had that time machine that I could have been able to do that more successfully. But on Wednesday, the Fed offered a speech in which they said, we're going to cut, but not yet. And then suddenly the market, I think, was shaken by the initial claims data on Thursday, the jobs report on Friday. Conceivably, the Fed might have had, maybe not the absolute levels of data, but had some read on what that data might have looked like, and they were calm enough to say, we're going to stick with our plan. In their mind, to the bond market, keep calm, and we're going to move on. But if you suddenly start talking about 50 basis point cuts in rapid succession, you're thinking we really are much behind the curve and there's something in a bigger crack coming.
So I look at some flows. I look at the money market flows. I'm not surprised to see that sort of rush of money into money markets. We're at peak. We're at a real sort of high. You're still able to get money market funds paying you 5.25. So I kind of understand that, a protective moment. But then I want to talk to you about the outflows. The largest outflows since September 2023, 12 weeks of outflows. Now, you could say that we were shaken in July, but there was the big rotation move into the Russell. So there were a number of different facets at play. That kind of flow, what does that indicate to you?
I think it speaks to the skittishness that so many investors wind up experiencing right now, and that, you know, I was a sell-side strategist earlier in my career. To some extent, one likes to lean into, I need to say something provocative to stand out from the crowd. Raising a recession forecast from 25% to 35%. Lies, damn lies, and statistics. It's a 40% increase in my recession probability. That's a provocative headline, much less so than saying my base case remains an expansive economy. So if you anchor off of the most recent data point, if you anchor off the loudest voice in the room, I can see where people say, I don't know where the world's going, I want to cut risk. I would prefer to take the tack of thinking, look at the major trend, try to stay long that major trend, and where I'll come back to is let's look to quality and try to anchor on quality that I think can power through the broader picture issues, the longer term trends, and might accept some day-to-day, week-to-week, and sometimes even year-to-year volatility on that volatility.
I mean, this is highly idiosyncratic. I had some lunch with somebody yesterday, and every day last week was, should I pair my NVIDIA risk? Should I pair my Mag 7 exposure? I said, ring your broker. Don't speak to me. You know, I'm not the right judge of that, and I won't do that job again. But here's the thing. Yesterday, the sentence that came from that person, which was, I'm prepared to stay in and stay long because I don't think the generic AI narrative is going back in the bottle. So there was a stoicism and a resolute stoicism after 5 days of huge volatility. And I just wonder, I know that's one conversation, but I think that's a pretty good example of where we are.
You know, you remind me right now of the Gartner model of technology adoption. You have tremendous enthusiasm. Then you have the valley of despair when you start questioning whether this technology will pay off as quickly as we think, and then ultimately people figure out how to make money off of it, and that's when the real fortunes wind up being made. NVIDIA up 100% up 100% as of this morning, year to date, after pulling back 20-odd% in the prior month. I like analogies. I was not great enough at math, so I'll go back to historic analogies. When you learn to sail, one of the first things they talk about is when do you put a reef knot on your sail? And that's that ability to control the sail under. When you find yourself being scared, you're going to be overpowered by the wind. And the example is you put the reef knot in when the sea is calm because you've actually thought about it, and you're not asking yourself to make logical decisions under extreme stress. So the idea, should you diversify a portfolio? Yes. Should you do it in the middle of a market meltdown? Harder to do, because that's when emotions are probably going to be trumping logical brain. Looking at AI, I think the AI story is incredible, but right now what we're finding is, how do you actually make money off of AI? And that's where the story remains a little bit softer in the shorter term, and where I think people can come back to whether I should be fully invested in AI, largely invested in AI, and that's the magic at the moment of trying to understand what's going on.
Can I square away in 30 seconds for you? When these cuts, if and when these cuts come, I read lots of research that says, look, I want to be long NASDAQ, small caps and consumer staples. Is that the diversity? I mean, consumer staples are under a lot of pressure at the moment.
Yeah, they are, because the dollar has been so strong for most of this year, and most U.S. consumer staple companies are global consumer stories now, not U.S. consumer stories. And so that, I think looking through healthcare has been a much more stable place. Certainly right now, you've got a lot more volatility around the election coming through healthcare. Is it good for Medicare? Is it good for Medicaid? Is it good for payers? But, those stocks are much cheaper than consumer staples.
Jack, thank you so much. Getting up early, joining us around the desk, that is Jack Caffrey of JP Morgan Asset Management. On the markets, stay calm and reflect. Context matters every morning on Bloomberg. Good morning from a beautiful New York.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The top names in global leadership are on Bloomberg.
We are 40 million. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. It's the world's second largest economy, with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Your Monday edition of Bloomberg Brief. I'm Manus Cranny in New York. Welcome to the show. The risks are abound in markets, and we are bracing for a week of full economic data. On the geopolitical front, Israel boosts its critical infrastructure amid heightened risk of attacks from Iran. Now, this as Iran reiterates determination to punish Israel for last month's killing of the top Hamas leader in Tehran. The Iranian Foreign Ministry releasing a statement on Sunday writing this: Iran will make Israel's violations costly for the transgressive regime in a legitimate and resolute manner. We need to put context around that. Bobby Ghosh joins me around the table. I mean, this is what it comes down to. It's the scale and the calibration of response from Iran and the proxies. People are saying to me it's going to be a multi-pronged attack from all of the proxies as well as Iran. What are you hearing?
That is the most likely scenario. We have to remind ourselves that in April, the last time Iran felt a great provocation when Israel took out a major Iranian commander in Syria, Iran's response was directly from Iranian soil. The first time that had happened, a Rubicon was crossed. So having done that, Iran now will feel pressured to raise the bar just enough that it doesn't become a sort of casus belli. This doesn't become a all-out war in the region. But it has to do more than it did in April, but it can't do so much that it creates a war. And the most logical conclusion is it does what it did in April, plus have its proxies attack from several different fronts. So you have a multi-pronged attack, a large single attack on Israel, and then you hope that Israel's allies restrain Israel from launching into a full-scale war. The problem is not that anybody wants war. None of the parties actually want a war right now. The trouble is that the situation has now reached a level of tension that it is all too easy for one or several parties to blunder into a war. That's the biggest thing.
Netanyahu have the capacity to blunder into war. He's prepared for defense as well as offense, to quote Netanyahu.
Well, yes, he has that reckless streak in him, as well as the possibility of blundering into one. He's very confident, not only in his own military forces, but he's very confident that the United States will give him all the support that he needs, military support as well. He's not really hearing different on that score from the Biden administration. Biden administration is cautioning restraint, but at the same time providing military hardware.
The political landscape is changing here in the United States of America as well. The verbiage, the narrative, one could say the political regime that Netanyahu has had cover from here is going to change. One way or the other. You're either going to have Kamala Harris along with Walz or Trump in the White House. So there is a window here of time that this war, as various papers have said, will recalibrate. New York Times, 10 months, a low-grade war is underway between Israel and Lebanon at the border that began with Hezbollah. So this is a window that is closing for Netanyahu, isn't it?
We take that, but Netanyahu's always counted on bipartisan support in this country. He's always been, remember, he came and spoke to both houses of Congress, and he spoke to both sides. He didn't get a chance to meet directly with President Biden, but he did go and speak to Trump, and he spoke to many of the Democratic leaders. He has always calculated that no matter who's in charge in the White House, there's enough bipartisan support for Israel in the American political landscape that he can count on the United States having his back. As I was saying, the Biden administration has been counseling restraint, but he's not listening to the words. He's looking at the actions. The actions show that the Biden administration will have his back should push comes to shove. The Biden administration is sending a nuclear submarine, is sending a naval attack group to the region, continues to supply weapons. So for all the words that he's hearing, whether it's from Biden, from Kamala Harris, from Donald Trump, he believes that America will be there when he needs it to be.
Bobby, thank you very much. Let's see how this week plays. Bobby Ghosh there with the very latest. Turning our attention to the big risks in markets. Sonali Basak sits down and catches up with a finance veteran, asking them what the next big risk is for markets. Here's some of that conversation with the Oaktree Capital co-CEO, Armen Panossian.
The biggest risk that I see with respect to the markets
and to society in particular is artificial intelligence. Artificial intelligence clearly has the potential for very large economic gains, revenue increases, cost efficiencies, and that investment opportunity is really exciting. It's easy to disregard the societal impacts of those same efficiency gains. What happens to normal jobs that are become obsolete because of artificial intelligence? Think of cashiers or drivers. As artificial intelligence becomes a real alternative to physical labor in some of those areas, millions of people could be out of jobs. So who's going to retrain those people? Because if we don't figure that out, that there will be social unrest, or there could be social unrest because of joblessness. In terms of the markets, artificial intelligence clearly is getting a lot of support from the markets. But just like the internet in the late 90s, there was this promise of revenues growing rapidly. While the gains are clear to see in terms of their potential, the timing of them is impossible enough. And if that timing takes a lot longer than investors expect, I would expect to see pretty violent resetting of valuations and potentially some losses for investors along the way.
What does this look like for an investor who's keeping a close eye on the economy, the job market, let alone investing in AI itself? It seems like the risk you're outlining here could impact many markets.
The attractive part of it and the scary part of it is that there isn't a monopoly on intellect that could be used to develop artificial intelligence technologies. There is a shortage of semiconductors and chips, but artificial intelligence allows economies and countries, and potentially those adverse to the US, to develop certain technologies and skills through artificial intelligence that could be problematic from a geopolitical standpoint. In terms of what investors should be looking at from the economy, it's hard to really have a leading indicator. I think, unfortunately, from the job market perspective, we're going to be looking in the rearview mirror probably after it's too late. So it's really hard to kind of pinpoint what economic indicators we should be looking for.
How do you think about this in terms of how people are behaving right now? Do you think most investors out there are ignoring these risks?
I think most investors are intoxicated by the opportunity in artificial intelligence. $160 billion being spent this year. That's just one data point. Another data point is a $3 trillion market cap for NVIDIA against $80 billion of sales on a trailing 12-month basis. Obviously, a lot of growth is expected for NVIDIA and for other businesses in the space, but that is yet to materialize, and it's impossible to know what the scale will be of an NVIDIA or other players in the artificial intelligence ecosystem. I think investors are just so focused on the opportunity set, on what it can be. As a result, you don't really focus on the risks. You're sort of just too excited about the opportunity.
Co-CEO Armen Panossian. On the risks posed by AI over-exuberance, Sonali is with me around the desk. Great interview. Very, very timely. He talks about a violent resetting in valuations, and that's maybe in the overall perspective of the AI trade. But I think he raises some big issues about universal income, the risks of replacing jobs. Everybody wants us to believe that AI is a wonderful boost for us, but there are real risks with it as well.
How often do you and I sit here, and many investors that we speak to really say that, oh, it'll replace some jobs, but it will make more jobs? Now we have another investor over at Oaktree saying, no, well, wait a minute. There could be a really massive impact here on the job market, not only violent resettings and valuations, of course, potentially companies that going bust, but also jobs being replaced. And of course, we know many investors watch the economic environment, but really his comment was more of a social one, and this worry about social unrest that could be created as a result of the AI boom. Now, I would say we give these investors a time horizon. We say, looking over the next 5 to 10 years, what are you most concerned about that investors are maybe not looking to? We ask twice a year. And so this, I've got to say, in the 5 years that we've been doing this project, AI is the first time this has really come up.
I mean, we're just trying to get to know him, and so this is a great window into a new leader there. Where does Oaktree's big opportunity come in this?
Well, remember, one thing I found fascinating about this was he did those 1990 comparisons, right?
Yeah.
The other thing, too, is Oaktree is a big distressed investor. So one thing they are doing is, while they are trying to get into this big opportunity in AI right now, they're looking for that valuation reset. They're thinking about that distressed opportunity already on the other side. I think that is a unique window as well, because Remember, Oaktree has traditionally been involved in credit markets, but of course, a lot of these big credit funds have been doing a lot more hybrid strategies. They're waiting for that valuation reset.
You also got up with Ann Walsh over at Guggenheim. I'm curious to see where she was on this whole perspective after a week of pretty turbulent markets.
Yeah, it's interesting. So what she's more concerned about, she says that she thinks we are still in this COVID era reset. This world where we're still feeding off of a lot of those COVID era policies that are contributing to inflation underneath the surface and contributing to that debt load that everyone is so worried about. She's worried about a black swan event that could finally set that debt load off course.
Okay, grey swans that morph into black swans. Shanali, thank you very much. Shanali Basak, thank you for joining us. Coming up, a big week for economic data. You've got retail sales. You've undeniably got the most important one, which is CPI, and that will be pivotal to the bond market in the middle of the week. Context Matters from New York every morning. Good morning.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto. The people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Look, let's frame it up for you. Elon Musk interviews the Republican nominee Trump, 8 p.m. Eastern Time tonight. That will be broad, wide-ranging. Let's see what the headlines are. Tuesday, PPI. Wednesday, CPI. Retail sales. Thursday, trifecta of data. Home Depot, have you been shopping? We'll find out on Tuesday, and Walmart on Thursday, so big retail week. A couple of stocks to keep an eye on. Starbucks, activist investor from Starboard Value, taking a stake, according to the Journal. Qualcomm cut to peer perform by Wolf Research. And Coinbase, Robinhood are among a few firms tallying customers' crypto, their balance sheets.
prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Now that we've priced in these greater odds of the recession, I would say the market is probably going to be more sensitive to any sort of positive surprises.
That might be part of the problem, in that we are being whipped around on every single cyclical data release.
Financial markets aren't as important as they think they are.
In my outlook for equities, it does not figure prominently what the Fed does, one way or the other.
They ought to be, and I think they will, erring on the side of caution if we do get additional negative data.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Did I miss anything? What did I miss? Welcome back. This is Bloomberg Surveillance. I hear it's August. Supposed to be sleepy. John and I are playing vacation tag this week. He's it. I'm thrilled to say Danny Berger will be joining myself and Anne-Marie for the rest of the week. So evidently I missed a doozy of a week last week. Trifecta of exploded carry trades, crowded positions, new growth fears. Question now, heading into this week, Danny, is roller coaster over?
I fear not, just considering all the data we have. PPI, CPI, retail sales. It almost feels like it's going to be a mini referendum on the little micro chaos of last week. Because, yeah, markets are basically right where they started. It's almost as if you didn't miss anything, Lisa. Well, but, you know, the volatility in itself is important.
But I missed some auctions that were actually important for once. So we'll get to that in just a second. There's still a question of what actually happened last week. And Anne-Marie, some people are wondering, is this just the idea of leverage getting pushed out of the system? Is this something really fundamental about the weakening of the consumer?
One thing we continued to hear last week, Lisa, was that this was really a perfect storm of a number of issues at play. This week, of course, the consumer will be front and center. We get those retail sales, but also we get the likes of Walmart. Remember, when they reported earnings in the last round, they said they saw broadly consumers starting to trade down. So that bifurcation of the consumer, maybe some of those on the upper end are starting to also look for deals.
There's also a question of how much this is political. There's been a reversal of the Trump trade almost entirely, and this question about whether the Harris wave has really begun and what that looks like. How much credence do people who you speak to give to that?
Well, Lori Calvasina put this in her note when all of this was really blowing up and the markets were experiencing all this volatility, and people are trying to decipher what exactly is driving this. And she said one dynamic could be the elections. They're shifting in a way that is challenging to the stock market. The S&P 500 has positively correlated with Trump's betting market odds, which have been deteriorating and now lag Harris. But Terry Haynes will be joining us, says, beware the Harris trade.
All I can say is there's so many different swirling winds. A lot of it, Danny, ultimately comes down to leverage in the system, which Goldman Sachs says had surged to some of the highest levels going back 10 years in data that they compile. Questions around the Japanese yen carry trade, how much that is over and unwound. Do we have a sense of how much some of the discrepancies in the market sort of positioning has really right-sized?
Well, every estimate is different. And I think this speaks to the point of it's kind of unclear. JP Morgan says 75% unwound the carry trade. Morgan Stanley says 60%. Bank of America says the bulk of it is over. But the concern is you had this big move on Monday, and the Japanese stocks rallied. I mean, they didn't even end down double digits for the week. So how much of that just encouraged people to reload back up? Yeah, sure, you sold off on Monday, but what if you saw that as, hey, it's good news. Stocks could end the week unchanged. Maybe we got complacent again.
Have we really killed off the optimism? Well, coming up this hour, we've got a great slate for you to really dissect all of what we've seen right now in markets. You could see basically trying to reclaim some of the losses that really didn't stick last week. This week, we're seeing just basically range bound 53.72 on S&P futures. Euro, this might be one of the most interesting areas to watch. How much the euro gains versus the dollar, not because of euro strength, but dollar weakness because of some of the Fed rate cut bets. 109.28, 10-year yield still sub 4%, 394.74. In crude, after a monster week last week of 4.5%, gaining yet again up more than 1%, $77.75 traded on the NYMEX. Here's what we've got coming up this week. It's going to be a really big one in terms of the consumer and in terms of inflation. We get PPI coming out on Tuesday. On Wednesday, we get CPI data. Does the Fed see inflation coming down, decelerating enough to justify the September rate cut and even potentially what's baked into the market, which is a 50 basis point rate cut at some point this year? Home Depot reports on Tuesday. Thursday, we get retail sales and jobless claims as well as Walmart earnings. All of this pointing to the key question, is the U.S. consumer getting too tired to uphold the rally that we've seen? Coming up, Michael Showell of Ion Macro Management with stocks coming off 4 weeks of losses. Terry Haynes of Pangea Policy as Kamala Harris pushes ahead of Donald Trump in 3 swing states, and Neela Richardson of ADP ahead of a key week of economic data. We begin with our top story, stocks edging higher ahead of a key week of economic data. Michael Showell of Ion Macro Management writing this: the market's reaction function seems to have flipped, with bad economic news driving risk assets lower, which typically occurs at the transition point for the economic cycle. Michael joins us now, I'm so pleased to say, in his very first interview in his new fund at the New Post. Michael, great to see you. Congratulations. I want to just start there. Are we really seeing a tipping point in the economy that justifies the volatility of last week?
I think, as I said, it's a change in the reaction function. It's not that the economic news has changed so drastically, but I mean, this all started with the CPI print. It didn't start last week. It culminated last week. It started on, I think, July 16th with that CPI print, with the dollar's sudden weakening. That was the yen sudden strengthening, helped by the Bank of Japan jumping in. And since that point in time, whenever we've had weak economic data, risk assets have gone down, the equity market's gone down, and when we've had decent economic data, it's gone up. We had a tiny beat on the jobless, on the initial claims number on Thursday. We had a stronger than expected ISM services index. The market was still down that day, but it rallied at the point that number came out. And this is something different. Since we started worrying about inflation in 2021, strong economic data typically sent the market down, sent yields up. So it's not necessarily that the economy is at a different point, but I think the balance of investors' concerns have changed. Investors are more concerned about a recession and a weakening economy than they are about the risk of upside inflation.
If we're talking about the reaction function of markets, last week bonds actually acted as a hedge, and you saw them become the haven trade that they have been traditionally. Do you see that sticking in periods that, according to what you're explaining, seem like they're prone for a lot more volatility?
I think right now, yes. I think for the remainder of this summer, I think that bonds will, as I say, if you get weak economic data, bonds will go down. Sorry, bond yields will go down, bond prices will go up, equities will go down, and the reverse is true if we get stronger than expected economic data. And so that's a little bit different. Now, that again poses problems for people who have set up portfolios anticipating a different kind of correlation. So one of the things I think which has fed into the chaos of the last few weeks is that portfolios are not reacting in the way people would have expected to a certain input.
That's a really interesting point. I want to dig into that more. So are you basically saying that a lot of this universe right now is set up that bonds and stocks don't have their normal negative correlation, that people currently are not prepared for this new environment that we're about to go into?
Well, or I think some of the chaos we've seen in the last few weeks that people suddenly, people are smart. If I've noticed it, someone else has noticed it. And you're probably starting to see people sit down and look at their portfolios and say, look, we no longer anticipate it to be, if I know that CPI this week is going to be 0.1 versus 0.3, this is now what I expect my portfolio to be doing.
Okay, so on that note, part of, and correct me if I'm wrong, part of the switch is that inflation isn't a concern. Because when inflation was a concern, that's when you saw the bond stock correlation got out of whack.
Yeah.
But what does it mean to have Fed officials, Michelle Bowman, Susan Collins, to still be saying we are not confident inflation is low enough that we can cut? What does the push and pull between markets and Fed officials look like then?
I think Fed officials and markets are often in a point of conflict. I personally don't think the economy is falling apart, but I respect the fact that the market's more worried about that than it used to be. As I said, to the extent you see Fed officials push against rate cuts over the short term, the market's going to be nervous.
But is the Fed almost creating this environment because they've become so data dependent?
Yes, and guidance dependent as well. I mean, the Fed did not used to guide in the way that it currently does. Look, I think setting Fed policy is always difficult, and it always goes through different fashions. If you went back 19 years ago, 18 years ago, the Bernanke Fed started under Greenspan. It was 25 basis points every meeting, and we used to joke, you don't need a calendar, you just need to tell me what interest rate it is. So we have this current paradigm with the dot plots and with sort of excessive guidance and data dependence. You're probably nearing the sell-by date. We're probably heading towards a much more opaque Fed. And if you end up with a Trump presidency and you listen to what he's saying, a Fed with a lot more political, even if it's only verbal interference, a lot more political interference.
When you say Trump potentially might come back into the Oval Office, we've seen now the race is very tight, and people are questioning if some of the unwinding was the Trump trade unwinding. Do you believe any of that? Is that part of it?
I do. I do believe that again, you had, it wasn't the biggest driver in portfolios, but at the margins, you did have people. It did look in that period after the debate as if you had a fairly straightforward election, as much as they're ever straightforward, and there were certain things which were favored, and certainly, it's no longer as certain as it was, or if anything, the certainty is moving in the other direction. So yes, at the margins, that will have been a factor.
So you're starting a new fund right now.
Yes.
What are you doing? How are you positioning it?
Not entirely sure. Still have a couple of weeks. Still have a couple of weeks to make up my mind. Look, I'll say this. I think this is this is a harder environment than markets were, say, 3 months ago. I think the global economy is still okay. I still think I think the Chinese are edging towards doing something. They're having their own battle with their bond yields being too low, ironically, and you're starting to see a little bit of impatience there. So I'm reasonably positive about the global economy. But as far as markets are concerned, I look back to summers like 97 and 98 that started off with similar chaos in FX. In those 2 years, it was EM rather than DM FX. And you got this sort of secondary wave of volatility in sort of September, October. I wonder whether that's something we have to look forward to. Again, both of them ended up okay by December, but you had some rocky periods to get through. So, September, October might get interesting.
Is this a financial problem or an economic problem?
I think it's a markets problem more than anything. I think you had tremendous imbalances in, everybody wanted to do a very limited number of trades 2-3 months ago. And okay, this all turned around in the middle of July. We've often highlighted to people the middle of July is a very important period because what happens is people start the year with a certain set of assumptions. Sometimes in the first half of the year, they realize they should have been doing something slightly different. So the first half of this year, people were quite invested. By July, everybody was fully invested. US tech was #1, short VN was #2. There were 2 or 3 other things in there. And I think what we had more than anything was a massive overcommitment of capital to a limited number of themes. And that unwinding is a messy process. We have to get back to more normal portfolios. And I don't think we're there yet. I don't know if it's 65 or 75. But you don't normally go from 100% commitment down to 0. You normally end up at minus 50. In other words, the pendulum overswings.
Well, good luck. And Michael Show, don't be a stranger. Congratulations again of Ion Macro Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Foreign investors pulled a record amount of money from China last quarter. Outflows reached $15 billion during that time, marking just the second time the country has recorded negative numbers. That's according to data from China's State Administration of Foreign Exchange. Should the decline continue for the rest of the year, it would be the first annual net outflow since at least 1990, when comparable data began. A Bloomberg survey of economists now showing the ECB is likely to cut rates once a quarter through the end of next year, a timetable that would see the central bank's easing cycle end sooner than previously thought. The economists expect the benchmark rate in Europe to reach 2.25% by the end of 2025. It had previously been expected to hit that mark in 2026. Growth in Europe's private sector slowed in July, while economists also lowered their forecast for growth in Germany. And Paris handed over the Olympic baton to Los Angeles in true Hollywood style, having actor Tom Cruise rappel from the roof of the Stade de France into the closing ceremony. LA will host the next edition of the Summer Games in 2028, and already planning is well underway, with the city's mayor addressing the big issue, saying they'll encourage remote work and non-standard working hours to prevent traffic chaos during what she calls a no-car Olympics. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I got to say, this was a very exciting Olympics. It felt like it was sort of more unifying.
You got to witness some of it.
Well, I went to Paris for a day. I didn't actually see any Olympic Games, but the enthusiasm there was really inspirational.
Well, you saw the torch, and I feel like that's everything, right? It's like in the center, it's this glowing orb. It's, yeah, what else do you need to see?
That's what I told
The
my
men's
son.
basketball game looked amazing.
Yeah, we'll talk about that more next. But more of this. Up next, the Harris trade rolls on.
We like hard work. Hard work is good work. And with your help this November, we will win.
That's coming up next. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Mohammed, we saw you there. We saw you in the stands watching the men's basketball game in the Olympics. You are at every single cultural icon event, and we want your life. Welcome back. This is Bloomberg Surveillance on a day where we're trying to claw back some of the losses that mostly were clawed back from last week. We're up now about 0.1%, 53.76. You wonder how many real people are in their seats or how many people take a page from the Jonathan Farrows of the world and are off on vacation. Euro climbing versus the dollar at 109. We're watching that pair very closely. Under surveillance this morning, the Harris train rolling on.
We know this will be a tight race until the very end. And so let's not pay too much attention to the polls because we have some hard work ahead of us. But we like hard work. Hard work is good work. And with your help this November, we will win.
Here's the latest. The Harris campaign riding a surge in donations, raising over $12 million in an event in San Francisco. Harris winning in the polls also. The latest from the New York Times showing that Vice President is leading right now Donald Trump in the key swing states of Michigan, Wisconsin, and Pennsylvania. Terry Haynes of Pangea Policy writing this: from now until the first debate, the race momentum very likely continues pro-Harris. Post-Labor Day, Harris is likely to be the clear front runner, but there are many potential Harris speed bumps. Terry joins us now. And Terry, I'm going to ask you the question that Anne-Marie and I were talking about earlier this morning, which is how much of what we've seen in markets is the unwind of the Trump trade and the Harris wave that we've seen in polls?
Oh, I think quite a lot of it, Lisa. There's a situation where everybody gets way over their skis for one event and anticipates it, and then when that starts to unwind, they jump on the other horse. And markets do this all the time. You don't need me to tell you that this morning. But the proof in the pudding is going to be whether or not those trades are those trades in that bandwagon is valid. And what markets forget in the presidential election years, but remember every other year, is that Congress has as much or more to do with this than who the president is. Right now, the base case is that the Congress is going to be politically split. So whatever happens with either of those trades is going to end up being less dramatic than markets anticipate, I think.
Terry, how do we know what a Harris trade is when we really don't know what her policies are?
That's a very good question. I think the answer to that is, not speaking for markets, but I think the answer to that is people consider and continue a status quo. That, by and large, the Biden policies will become the Harris policies. Number one, and number two, what you do get is a Democratic platform that's already been approved by folks and will be rolled out at the convention. That's already out there, so you have some idea of what there is. What I hope markets see beyond all this is an increase in defense spending and building up the defense industrial base, regardless of who the president is, frankly, because that's the most bipartisan policy there is.
You mentioned Congress, so I want to give you a little bit of what President Biden had to say over the weekend. He said one of the reasons why he dropped out was a number of his Democratic colleagues in the House and Senate thought that he was going to hurt them in the races. Have you seen materially in the polls, since Biden have stepped aside, down ballot, that potentially there is more seats that Democrats can pick up, whether it comes to the House or the Senate?
Well, I think so a little bit. Yeah, I'd take issue with the president. Even before he dropped out, the vast majority of people were running ahead of him, particularly in the Senate. Senators, incumbent Democratic senators that are up for re-election were already doing better than Biden was. So there was a lot of talk that those senators actually might pull Biden up rather than the effect that Biden talks about. But yeah, I think what happens is that the Democratic idea of taking the House back by targeting a relative few seats in blue states probably is more likely to happen than less likely to happen, simply because the enthusiasm for Harris and the enthusiasm for the ticket is way up compared to where Biden was.
One piece of policy we have been able to get out of both campaigns is how they view the Federal Reserve. And over the weekend, J.D. Vance doubled down on what the former president said in terms of potentially the president should have more say on directing monetary policy. Do you think this can hurt the Republican ticket?
Yeah, I think it does on balance. You know, what Trump and Vance are trying to appeal to is this kind of end the Fed crowd. And, you know, you're at this point in a campaign, you're throwing out little bits of meat for everybody and, you know, and on the hope that they bite and stick with you. But, you know, I think on balance, it's silliness or worse. The idea that, you know, it's a very short step from talking about how to corral the Fed, which is constitutionally impossible for the executive branch, by the way. I mean, these are powers derived from Congress. It's not anybody's opinion. It's not a fourth branch of government. You know, the Fed exercises congressional powers, you know, kind of end of story. And the Congress is not going to give that up. But when people see that, excuse me, when people see that the net effect of what Trump and Vance are talking about is going to negatively affect their savings and their pensions in the marketplace, you know, that's a losing argument for that ticket.
Terry, another piece of policy that we could probably argue is a piece of meat being thrown out there by both candidates is this idea of no taxes on tips. Both of them have coalesced around it. Trump was the first to say it. Harris talking about it over the weekend. Where does that land us on tax policy for the two of them? What did you make of it?
Well, that's, you know, we'll go back to where you started. It's a great little bit of meat, and sure, why not? You know, it lends itself to the immediate riposte that you know, well then, you know, why don't we talk about income from whatever source derived and then start to make exceptions? I think once you get into, in the very unlikely event today that you get into an extension of the 2017 tax law, I say that because a split Congress, no matter who the president is, a split Congress with either House Democratic is not going to entertain an extension of the 2017 tax law. You know, I think that unless you get some sort of Republican clean sweep, this doesn't happen, because what ends up happening is that they want to capture as much revenue as they possibly can. So, you know, it's a little bit of enticement for people, but in the end, it won't happen, I don't think.
Terry, is the Trump conversation tonight with Elon Musk on X, formerly Twitter, probably going to be more of a liability or a boon for his campaign?
You know, I think on balance, it'll be a little bit of a boon, and it's worth watching for this reason. It's really about two things, I think. One is it's about kind of cross-marketing, right? I mean, you know, Musk wants to highlight a free speech platform, a freer speech platform, you know, from the background that that a lot of the social media were colluding with the government on things in 2020 and thereafter. It's also about rebranding the Trump campaign as the resistance, and that sounds like a leap, but you can see it in Musk's tweets, where he tweeted just yesterday or the day before that, you know, you see in movies, you know, and you identify with the resistance in all movies, Star Wars, Divergent, this, that, and the other, but you don't see it in real life. So I think what you're going to see here on this interview is a rebranding exercise where what Musk wants to do is attack the what he characterizes as the anti-free speech posture of the Harris-Walz ticket, and what Trump tries to do is tries to start the conversation around exposing Harris as more than a shapeshifter, but as just another politician who's taking whatever stands suit at the moment. So, you know, we'll see where it goes, but I think that's what you're going to get out of it tonight.
Terry Haynes of Pangea Policy, thank you as always for your insights. And if you want to find the End the Fed crowd, Twitter or X is probably one of the best places to do that. Coming up, the latest on tensions in the Middle East with Bloomberg's Bobby Ghosh. Right now in markets trying to claw back some of the losses that last week were still a little bit left over. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
So it sounds like it was really volatile. We saw the biggest spike in the VIX going back to the early days of the pandemic. We saw the yield curve uninvert for the first time in at least 2 years, and the S&P lost negative 0.04% in the week. Right now, people are trying to claw back and maybe even turn that again to reverse some of that volatility. S&P futures up about 0.2%. The NASDAQ clawing back some of the losses after some of the big tech darlings were thrown out with the bathwater, maybe the first things to sell in a crowded unwind of a carry trade, up about 0.3%. Russell, interestingly, is lower. And honestly, I want to sit on this for a second, Danny. How much is this a growth scare versus actually an economics, versus actually some sort of financial scare? If you see the Russell down 0.4%, even with some of the rate cuts priced in.
Well, the market certainly treated it as a growth scare. And I think it's fair to say this is not a recession, because after all, recessions aren't events. It's a process. You get there eventually. But I think when people were buying up the Russell to an extreme pace, a lot of us were questioning, do the economics back this up? Is this really early cycle and you can get all these cyclical companies and all this, let's be honest, unprofitable junk that's in the Russell 2000 to actually rally? Perhaps the past week was just a reminder that the economic environment is not ripe for that.
There's also this really key question is whether the rate cuts that are being baked into the market will be positive for equities or negative. If you switch to the boards and take a look at what we're seeing in the yield space, we are seeing a reversal of a lot of the decline in yields that we saw last week. Yields continuing to climb higher. Now, two-year yields back again north of 4%, 4.05% after plunging about 20 basis points last week. U.S. 10-year yields 3.95, 30-year yields 4.23, and this came after a pretty poor 10-year and 30-year auction. Danny, to me, there really is this key question about whether the Fed actually is poised to cut by 50 basis points if you have the likes of Michelle Bowman coming out and saying, actually, pump the brakes, guys. I don't really see what you're seeing in terms of inflation falling off a cliff and growth really becoming the preeminent concern.
That is it. The market has moved on from inflation being the concern. It is concentrating on the Fed's other side of the mandate. And this is the big risk for bonds, that we are potentially still in an inflationary environment. How are you going to cut 100 basis points for the rest of the year if Fed officials themselves aren't even saying that they're ready to cut 25 basis points?
And this has been one of the questions as people maybe price out a 50 basis point rate cut in September, but another one later in the year with 100 basis points of rate cuts priced into the market right now. If you take a look at the dollar, to me, this really might be the linchpin of everything that was happening last week. And it's not really the dollar as much as the yen and what happened there with a surprise hawkish hike from the Bank of Japan and the subsequent sort of right sizing of that currency pair. Now 147.39 after being as high as 160, 170. A question now for the euro is whether it can continue to climb at the pace that it has over the past
last week, 109.26, given not euro strength, but dollar weakness because of some of those Fed rate cuts. Under surveillance this morning, a raft of key economic data out this week. We'll get PPI tomorrow, followed by CPI on Wednesday, plus another round of jobless claims and retail sales on Thursday. We'll also be hearing from key consumer giants in the retail earnings space, which is Home Depot and Walmart. What are you looking for, Emery? I mean, in terms of the most important indicators, particularly as it has to do with where the levers for the Fed really are.
So I feel like given the fact that the market is swinging, like yet last week when we got the jobs number, initial claims, they were acting like it was a real non-farm payrolls report. I think for the market, the data is going to be really important, especially when you hear the likes of Mickey Bowman talking about the fact that inflation still is key. But for me, I'm interested in what the consumer is spending on. When you look at Home Depot, these are big ticket items. There is a housing slump. How do they fare versus, say, a Walmart, which has said that it's now starting to see higher end consumers trade down into their marketplace? So I want to hear from these big companies on what they see on the ground from their consumers.
And I think you got to assume that that's what the market is concentrated on, right? Because of these recessionary concerns. The thing I'm looking out for is what if CPI comes in even just a tad hotter? Do we all of a sudden see this huge pushback from the Fed of the likes, again, to your point, which we're already starting to see, and not just continue into Jackson Hole? How offsides is this market if that's how this week plays out?
Which is some of the reasons why it might be a bigger week to actually watch some of the Fed speak as well, not just some of the economic data. Foreign investors, meanwhile, pulled a record amount of money out of China last quarter, the latest sign of pessimism around the world's second largest economy. The numbers are pretty shocking. Investors pulled almost $15 billion in the second quarter, the second time the country has recorded an outflow in data going back to 1990. This is according to state data from China. You know, it just starts to raise this issue of how fragile, Emery, China is, and how that factors in not just in an economic picture, but a geopolitical picture, as you start to wonder how desperate they are to flood the market with goods.
And there's a question on whether or not these two issues are interchangeable. One, the economy slowing, and two, geopolitical concerns. Last week we got data, inflation rising very so slightly in China, but that was due to weather. There is still a serious demand concern, but the likes of Goldman Sachs says potentially the Chinese government is waiting on the sidelines, even though they put out this 20-point plan about fiscal spending, because they're waiting to see on the political front who wins the U.S. election.
Yeah, and this really goes to the heart of what even we heard from Michael Schawel, Danny, which is that essentially this is one of the wild cards. Will they pump some sort of fiscal stimulus into the economy to create that kind of ballast to the global economy that right now is missing? And ultimately, how much are investors even counting on that at all?
Well, it's a philosophical barrier because you have President Xi previously saying that he doesn't want that Europe-type stimulus into the market. So it would be difficult for him, again, to backtrack on what he sees as a core principle for this Chinese economy. So you have all the stars aligning of geopolitics, weak demand, and not to mention local competition. You see this with the autos. Porsche really struggling in their earnings because all of a sudden China flipped to not just EV demand, but local and cheap EV demand. So it's all these things coming together that makes it unappealing for internationals.
Well, talking about geopolitical risk and some of what's heating up there, Israel right now is strengthening its infrastructure defense as it faces heightened risk of attacks from Iran or its proxies in the Middle East. This comes as Iran reiterates its pledge to seek revenge for the killing of a top Hamas official in Tehran. Joining us now is Bloomberg's Bobby Ghosh, and we are just getting the latest from the Wall Street Journal saying that the U.S. is planning to send a carrier and a missile submarine to the Middle East in preparation for the retaliation from Iran. Can you just give us a framework for what we're expecting in terms of what the retaliation might look like?
Well, so Iran keeps saying it will retaliate, and there was a statement overnight from the Iranian foreign minister to that effect again. Iran knows that it can't keep making these statements without actually doing something, because that undermines its credibility at home and with all its proxy militias in the region. It set a bar. Iran set a bar last April when the Israelis took out a senior Iranian commander in Syria. Iran responded for the first time by retaliating from Iranian soil. Remember, they fired off 300 missiles and drones in the direction of Israel. It was a bit of a showpiece. They gave Israel plenty of time to prepare. They gave plenty of advance warning, so no actual damage was done, but it was symbolic. But it set a bar. Now the challenge for Iran is calibration. It has to raise the bar. It can't not. This is Israel taking out an important target in Tehran. But at the same time, it has to calibrate in a way that it doesn't set off a war. Iran does not want a war. None of these players want an actual all-out war because the damage from that is far too great. Their economies won't sustain it. So how do you raise the bar without actually getting into a war? The most likely scenario, and all kinds of defense experts are sort of looking out for this, which is that Iran fires off another volley of missiles, maybe more than last time, more than 300, from Iranian territory, simultaneously has its proxies, Hezbollah in Lebanon, Hashd in Iraq, and the Houthis in Yemen all also fire off a volley of missiles and drones and rockets. So it's a much larger number of it's a much larger aerial attack coming from multiple sides. The challenge then for Israel is, does the Iron Dome, the famous Iron Dome, does the Iron Dome, is it capable of taking this multi-pronged hundreds of missiles from all over the place? One. And then the second challenge is for Israel's allies, especially the United States, can we then restrain Israel from going up one more notch? That's the risk. The risk here is not that any of the parties want a war. The risk is that we've reached a stage where any of the parties all too easily and unwittingly can blunder into a war. That's the real risk, that something will happen that pushes everyone over the edge. We are far too close to the edge now.
On Thursday, we're supposed to have these talks, but Hamas is not going to be attending. No. So what are these talks?
For me, these talks have now become a sideshow. It's very clear that Hamas is not really interested, especially now that they have a new leader, and the new leader is the guy who planned the October 7th attack, Yahya Sinwar. He's not a guy who's even remotely interested in any kind of peace and releasing the hostages, and he's perfectly happy to keep fighting till the last Palestinian. On the other side, it's very clear that Benjamin Netanyahu is not particularly interested in a deal at the moment. He's had plenty of opportunities and a lot of pressure from the Biden administration to make a deal. He just doesn't want to. And so these talks, I'm not holding my breath over them.
So do you see these talks, though, as domestic politics, or is it a Hail Mary event to potentially try to restrain Iran? So if there was a ceasefire deal, potentially that would mean Iran can hold off on retaliation.
I don't think Iran will be sort of moved by that. I think the Iranians, like me and like anybody else who's been watching the region closely, I think all of us sort of agreed that these talks are not really going to make a material difference. For Iran, the calculation is a question of just how much to do without getting into a war. I don't think the talks are for domestic consumption. From Israel's point of view, it's for international consumption. This is Netanyahu saying to the Biden administration, you want me to keep talking? Look, I'm talking. Meanwhile, he keeps bombing schools in Gaza. They keep provoking the Iranians and Hezbollah. So everyone continues to do what they're planning to do, and they have this little thing on the side where they show the world, look, we're reasonable people. We're talking about peace.
I was going to say, it wasn't that long ago that the Biden administration was talking about Israel crossing red lines and what that means for sending them weapons. And as Lisa mentioned, the latest story is sending, carriers and missile submarines over to Israel. Yeah. So what do we make of sort of the carrot and stick that the U.S. actually has to prompt any sort of response or any sort of de-escalation from Israel?
It's hard to take the stick seriously, the supposed stick. The Biden administration, again, I just saw a report before coming on air, is again now saying that we've made it clear to the Israelis that if they don't take these new talks seriously, we'll start naming and shaming them. I don't think they will. The Biden administration is briefing journalists in Washington off the record. Netanyahu is a past master at playing the bluff game on the international stage. The Bidens are trying to kid a kidder. That's not going to work. Netanyahu's not really paying attention to the rhetoric coming out of the White House. He's paying attention to the Biden administration's actions. And the actions are, we're sending an aircraft carrier group, a nuclear missile group. We're sending all the arms that Israel needs. That's all Netanyahu cares for. He knows for a fact, and he knows from long experience, that no matter what the occupant of the White House says, he did this during the Obama administration, no matter what the occupant of the White House says, there is a bipartisan agreement or consensus in the United States, in the Senate, in Congress, and in the political landscape in this country, that the U.S. will always back Israel no matter what. Netanyahu is counting on that, and it has never failed him before.
Bobby Ghosh, thank you so much for your insights. Always wonderful to get them. Hopefully we'll talk again soon of Bloomberg. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Bank of America CEO Brian Moynihan telling CBS the bank no longer sees a recession on the horizon for the U.S. economy. Moynihan going on to say consumer spending is slowing, but it's heading to normal. On the Federal Reserve, he said, quote, the Fed is in a position where they have to be careful that they don't slow down too much. Moynihan says the bank expects the Fed to cut in September and December. Former President Donald Trump plans to sit for an interview tonight on X with its owner, Elon Musk. The billionaire is promising an unscripted discussion with no limits on subject matter. Musk often butted heads with Trump when he was in the White House, but he endorsed the former president after the attempt on his life last month. Elon Musk's interview with former President Trump on X is set for 8 p.m. Meanwhile, President Joe Biden is giving his fullest explanation yet for why he decided to end his re-election campaign. In an interview on CBS Sunday morning, he described the pressure within his own party to step aside.
The polls we had showed that it was a neck-and-neck race, would have been down to the wire. But what happened was a number of my Democratic colleagues in the House and Senate thought that I was going to hurt them in the races. And I was concerned if I stayed in the race, that would be the topic. You'd be interviewing me about why did Nancy Pelosi say, why did someone, and I thought it'd be a real distraction.
Biden is expected to join Kamala Harris on the campaign trail as soon as this week. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, it is all about the data.
We've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is. It's been a bit of a perfect storm of events, but I think that the growth scare has actually been building up in people's concerns for a while.
That's up next. This is Bloomberg Surveillance.
About artificial intelligence. Is artificial intelligence going to enable you and others to say we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Everything's over. People are on vacation. I'm back. John's off for the whole week. Right now, you're seeing markets claw back some of the losses from last week. They were pretty much all clawed back anyway, up about 0.2%. Really, this question of how much of some of the leverage trades really have been unwound and how much of the economic concerns are sort of rooted in reality. And under surveillance this morning, it is all about the data.
We've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is. It's been a bit of a perfect storm of events, but I think that the growth scare has actually been building up in people's concerns for a while. If you were to see a continued deterioration in the data, well, the Fed themselves are going to have to respond in kind.
That is certainly what the market is betting on. Here is the latest, a key week of data set to provide further insight on the health of the U.S. economy and the Fed's ability to really cut rates. U.S. PPI coming tomorrow, followed by CPI on Wednesday, ahead of retail sales, as well as another round of key jobless claims on Thursday, which have renewed importance. Neela Richardson of ADP writing this: with all eyes on September's Fed meeting, CPI will be the most important indicator of the week, or maybe even the year. Neela joins us now. Neela, I am thrilled to have you. We are thrilled to have you here in the studio, especially at a time where there's so many questions about what's actually going on in the labor market. You point to a slew of statistics showing that we are still above pre-pandemic levels of hiring. Does that mean that we are out of the woods? Is that basically a good reference point at a time of deceleration, and we don't know where the end point really is?
I don't think we can be conclusive with this data, but we can actually give context to what we're seeing. It's undoubtedly that the labor market is cooling. Everybody's talking about it, but we never say where we're cooling from and where we're cooling to. And right now, we're cooling from really abnormal hiring levels. When you look at small firms, when you look at new business formations, we're going back to something that resembles 2019. Will we stay there? That's the open question. I can't give you a definitive answer on that, but the normal has recalibrated, and now normal looks a lot like 2019 with some interesting changes, like new business formation, which I point out in my blog this morning. We're seeing record numbers when you look at over the past 10 years of new business formations, even still. And about a third of those are high propensity businesses, which means they have the potential to actually add payroll and headcount. Those are the new employers. Those are the new job creators. And that's a little bit different than what we saw in 2019.
Before we get into that, and we will in just a moment, how much does this sort of undermine the conclusion that a lot of people had from the July jobs report that came out really disappointing and raised a lot of concerns about a recession and about the Fed potentially cutting rates by 100 basis points this year?
So what we're seeing is a market of investors and speculators that are overreacting to economic weakness and ignoring economic strength in the Main Street economy because they're not seeing it. They're not seeing the mom and pop hiring that we see in the ADP data. They're not seeing, and maybe not looking at financial conditions when it comes to small business loans. They're looking at the bond market. So to look at the economy in totality, yes, you're going to see some weakness, but you're also going to see some areas of strength. That's why this data week is so incredibly important, because not only will you see financial market indicators, you're going to get retail sales. You're going to get a sense of how Main Street is doing next to all these price data that the market is following so closely.
Well, I think one of the difficult things for these markets is we're struggling what the recession indicator is, that things in the past, like a yield curve, SOM rule, as Powell says, are just statistical regularities, that this time is different. What should be the indicator? How will we know if we're heading towards that? Or is it like frog in a boiling pot of water, that by the time we're there, we know we're there, it's too late?
If you really want to know the direction of the economy, you always look at the consumer. Is the consumer still spending? That's the data point that's important. And is the consumer still spending ahead of inflation increases, or are they spending with a little bit of tailwind at their backs with that inflation number going down? That's exactly what we'll see this week. And if you look at last month's data, consumers were holding the line. They were doing okay. And this is an okay economy. It's not super strong. It's not super weak. It's holding the line, and that's pretty good when you consider the inflation headwinds that we've all experienced over the past 2 to 3 years.
Well, to that point, Lisa started out with this idea that for you, CPI is the most important statistical point this week, despite a market that seems to have moved on from it. Why is inflation still important this week?
Because it really is important to the Fed. Now, it's not the preferred indicator. We all know that, but it is an indication. And I will also argue that PPI, those producer prices, are actually gaining momentum in terms of interest, because people are going to be looking at PPI to see the through line, the pipeline to that very important PCE report that the Fed really cares about. So the fact that producer prices can bleed into consumer prices, super important, but it's just going to be one more piece of evidence that the Fed needs, that they're comfortable with cutting rates in September.
Last week we heard from Thomas Barkin, and he said there's no hiring, there's no firing. Basically, we're flat. But you are seeing a pickup of hiring in these smaller, less than 50 people establishments. What are you seeing? Like, what exactly businesses are these? What are they looking for when they go to the job market?
Right, so a lot of them are mom and pop Main Street businesses. So you're thinking about those consumer facing businesses, restaurants, bakeries, dry cleaners, those parts of the economy that kind of keep churning regardless of whether or not there are recession fears. And those employers were really blocked out last year as larger employers were still hiring in force. It really took some time for them to get a window into this labor market, this talent market. And you saw that pick up last year. Now they're normalizing, but they're still adding headcount. And that's a really important indicator. And I'll also argue that the demographics are changing the labor market. So with all these retiring baby boomers, not all of them are going to Corsica. Some of them are actually opening new businesses and becoming non-traditional workers in this labor market, contract workers. And that's going to be a change that we see going into the future, because they're not just becoming traditional workers. They're becoming business.
That was a shot for Lisa, not John, even though he's also he's off this week. Lisa was last week. When you look at when you look at the changing market,
I was anonymous. I was.
Big time. We saw where your eyes look, Mila. So when you look at these changing dynamics, it's not just the boomers potentially leaving the workforce. It's new flows of supply coming in with immigration. How do you view that immigration supply right now? Because some are saying that is the reason why we have to discount things like the SOM rules, and others are saying that some economists are using immigration too much of a point, and that there actually isn't as much as we are expecting.
Right. I mean, no one makes a better case for why this might be different for the SOM rule than Claudia Sahm herself, which she says, you know, immigration is not anticipated in that rule. And so if you're seeing a pickup in immigration, and we have,